What's up, everyone? This is Anthony Pompliano. Most of you know me as Pomp. You're listening to Off the Chain, simply the best podcast in crypto. Let's kick this thing off. The following conversation is with Mark Yusko, the founder and CEO of Morgan Creek Capital Management, and one of my two partners at Morgan Creek Digital. In this conversation, we cover a lot, including his background, what it is like to run a university endowment, the Morgan Creek founding story, how institutional investors think about portfolio construction, how demographics affect financial asset performance, why inflation steals wealth from the poor, how banks take control of your money when you deposit it, the best advice he's ever gotten, why governments help companies manipulate their stock prices, what the benefits of Bitcoin are to institutional investors, and where he expects Bitcoin to go in the future. I really enjoyed this conversation, and I hope you enjoy the 150th episode of Off the Chain. Skirt, skirt! Want to know who has the best URL? Crypto.com. That's right, Crypto.com. They're a crypto platform with one goal, motherfucking mass adoption. That's why we're all here. We're trying to get crypto in every wallet. Crypto.com is helping people do that through buying, earning, lending, and card payment. Everything you could want at Crypto.com. Go help your boy out. Tell him Pomp sent you. Download the app or visit Crypto.com. Pomp's got you, always. Ever wanted to get into mining and didn't know how? Don't worry, your boy Pomp's got you. Everybody got some electricity and Wi-Fi. All you got to do is go to coinmine.com. You buy a coin mine. It's like an Xbox or a PlayStation that helps you turn your electricity into Bitcoin. That's right. You purchase it. It shows up at your doorstep. You pull it out of the box. You plug it in, connect to your Wi-Fi. 5 minutes or less, you're mining Bitcoin. All you have to do is control it from the mobile app they provide, and then you receive over-the-air updates that add new coins and new features on a consistent basis. Kind of like how Tesla does over-the-air updates and updates the car software. Just you're updating your coin mine. Consumer mining made easy. That's right. Go to coinmine.com, tell them Pomp sent you, and thank me later.
Anthony Pompliano is a partner at Morgan Creek Digital. All opinions expressed by Pomp or his guests on this podcast are solely their opinions and do not reflect the opinions of Morgan Creek Digital or Morgan Creek Capital Management. You should not treat any opinion expressed by Pomp as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. This podcast is for informational purposes only.
All right, guys. Bang, bang. This is one of two one-year anniversary episodes that we're going to record. I'm cheating, and I've brought one of my partners, Mark Yusko, in for this episode. The other episode is with Jason Williams, our third partner. And Mark and I are going to sit here and pretty much talk about everything that we talk about every day. And you guys will all see the intellectual horsepower that he brings. And hopefully by the end of this, this becomes one of the most popular episodes that we've ever recorded. So thank you so much for coming and doing this.
Oh, thanks for having me. I am beyond excited. And
he scared me this morning when he said that he was bringing questions as well. So we'll hopefully avoid those. All right. So I know you, but a lot of people listening might not. Let's start with your personal background and kind of what you did pre-Morgan Creek.
Yeah, I will go back to go forward, I guess. I always say I don't do short well, so good thing we got a lot of time. But how far back do you want to go? So I'll go all the way back. I grew up on the left coast, grew up in Seattle, Washington. Left there a long time ago, but that's where I grew up. Moved around a lot in high school, went to 3 high schools, hated my parents. I have
Doesn't everybody?
Them. Yeah, exactly. But think about it. I went from Seattle, Washington, hair down to my shoulders and bell bottoms, to Weston, Connecticut, had to cut my hair and wear corduroys, to Houston, Texas, had to get a cowboy hat and go to the rodeo. So yeah, it was
big
tough.
Difference.
Yeah, but I learned how to be resilient and how to fit in and all that good stuff. Went to Notre Dame for college, went to be an architect. For most listeners who have no idea who Mr. Brady is, I wanted to be Mr. Brady from the Brady Bunch. And it was a show about the family, coming together. He was an architect. I thought it was a cool job, but I lasted 1 semester in that. Didn't really like it. Turned out I'm not a subjective person. I need objective things. So changed to electrical engineering. That's what Dad wanted me to do. I didn't love that either, and had a girlfriend who said, well, why don't you do what you like to do? Like, well, that's a novel concept. So I did that, and I did biology and chemistry, thought I wanted to be a doctor. Graduated pre-med, took the MCATs. Bad decision. If you're not going to be a doctor, don't take the MCATs. Decide before. But didn't go to med school, went to business school instead, and came out and took the first job offered as an insurance. If I was a resume inflator, I'd say I was an M&A analyst. I'm not a resume inflator, so I was a business analyst. But what did I do? I made spreadsheets, because back then no one knew how to do spreadsheets because they had just started existing, from VisiCalc to Lotus 123. And my boss didn't know how to do spreadsheets, so he said, hey, do spreadsheets. We bought little insurance companies into the bigger insurance company. And fate would have it, I say my life is a series of happy accidents. The guy who was doing investments retired, and my boss said, hey, you want to do investing? I'm like, great. So we started managing a fixed income portfolio. And what was interesting about that is we did a little bit of both. We ran some of the bonds in-house, so learned about how to do analysis on fixed income, but also we allocated some out, and went out to search for managers. So I had my first exposure in searching for talent, and got lucky, hired Dan Fuss before he was famous, legendary bond manager. Hired another guy, Mike Brilli, up in Minneapolis that no one had ever heard of, that had this really cool way of buying bonds that were prepackaged into these deals but were backed by U.S. Treasuries, so you got a big boost in yield, even though you had real good security. So we did that. And interestingly, and this kind of goes to my whole history of how I got to Notre Dame, is I got a letter. You know, people are like, what the hell's a letter?
Like a physical one.
A letter, like physical letter with a stamp on it. And it was from my alma mater, from Notre Dame. It said, we're looking for an assistant investment officer. I'm like, I don't know what that is, but hey, I want to go back to my alma mater. So great. So I applied and went down, I interviewed, and it came down to me and another guy to work in the investment office at Notre Dame, which was just being started. And turns out the other guy had equity experience. I only had bond experience. And Scott Malpass, who was the CIO at the time, said, I'm going to go with the equity guy. I'm disappointed, but I didn't really think too much of it. And I had my first experience with everything happens for a reason. There was a reason that happened. And the big reason was, for those next 2 years, Scott really wasn't ready to let people do investment stuff. He just wanted someone to build the spreadsheets and the back office, the infrastructure, which I would have hated, not being a detail guy. And the guy who took the job, hated it. And 2 years later, I had gone to work for an equity manager, was down at Notre Dame talking to Scott, pitching him our product. And he said, hey, you still interested? And I said, yeah. I turned my paper around and said, yeah, write me an offer. I'll sign it today. He unfortunately didn't do that. He actually made me interview again. He made me take a test to make sure I could actually do spreadsheets. And I was a little concerned because we were a year apart at Notre Dame. We lived in the same dorm, same major, pre-med. Two guys end up in investing.
Really?
We'll come back to that topic, which is a really important topic. Why I think science training is the best training for investing. And I was nervous about working for someone who's only a year ahead of me, and he had this great line. He said, don't worry, it's going to be Batman and Batman. I was like, all right, that works for me. And it was great. So I went, spent 5 years at Notre Dame. And what was great about it is, I'd gone to work for two professors at Northwestern. We ran a value investing style, and we had $1 billion back when $1 billion was a lot of money. And these were like the first professors that spun out of the university to manage money. And one of the cool things about it, and it'll come back to when we start talking about technology, is they were using technology in a way that no one had before in investing, in that they were running screens of stocks using the VAX computer, the big giant mainframe computer at Northwestern. So they're professors during the day, they ran these screens at night, and they had this business on the side that made them way more money than what they got from the professor, from being professors. And they built this great business. And I probably would have stayed there forever. We had a nice little business. The top guys kept all the money. Us young guys would have eventually got something. But I wanted to go back to the alma mater. And there's this story I tell that is true, that Lou Holtz was the coach at Minnesota at the time, football coach. And he had a lifetime contract unless Notre Dame called. Notre Dame called. He went back to, he went to Notre Dame and had a great career there, 11 years. And I had the same thing. I probably would have stayed at Discipline Investment Advisors, but I wanted to go back to Notre Dame. And And the cool thing, again, things happen for a reason, is I thought investing was all about stocks and bonds. It was just about analysis and picking stocks and bonds. And when I got to Notre Dame, I realized, geez, that has hardly anything to do with it. Investing is all about the big picture, about asset classes, and about getting out in front of big demographic and secular trends. And that's what we did. And we did a bunch of things at Notre Dame that to this day I tell stories about that, were really amazing. I mean, we started looking at international private investing long before other schools. And we followed Stanford into some venture capital deals that were extraordinary, one being Google. We literally gave this company that no one had heard of at the time called Sequoia. Now everybody knows Sequoia. And Michael Moritz had never done a deal at the time. He was a brand new guy at Sequoia. And we gave him $5 million. They took 10% of that, put it in this little company called Google. And at the time, people were like, Google? It's a stupid name. And why do we need Google? There's 20 search engines. We got Alta Vista. We got Web Crawler, my personal favorite. Why do we need Google? Well, they had better technology that nobody knew at the time. Well, the guys at Google knew, but they didn't know. And, the rest of the story is that $500K turned into $200 million, right? There should be a quad at Notre Dame called the Google Quad. And so we did a lot of good stuff, and I learned a lot of great things. But spent 5 years there, loved it, and then started to get the calls. And Jack Meyer had been a mentor. He was at Harvard. I had kind of run into him through some conference stuff, and he decided to take me under his wing. And when the recruiters would call him and say, hey, who should be a CIO? He'd say, hey, call that Yusko guy. And it was great, and I appreciated it. And Chicago called, my other alma mater, my business school alma mater, and interviewed there and looked at that. But then North Carolina called, and I said to my wife, there's a job in North Carolina, I should take it. I said, don't you want to know what it is? She said, no, I just want to live in North Carolina. And she was right. And so we moved down there sight unseen. And the real thing about North Carolina was it was broken. Right? If I had gone to University of Chicago, Chicago was a good school, had a good board, had a good portfolio, good performance. The great thing about going to North Carolina, it was totally broken. 84th percentile in performance. They had like 11 managers. They had no diversification. It was managed by a board of 11 guys. No, all guys, okay, and 9 of them from the same fraternity.
Now, so this is, 97?
97, 98, yeah.
Right, you go and take over the endowment at University of North Carolina.
Yes.
And this board, go ahead and explain more about
think about it. So we all know that diversity of thought is a good thing and new ideas is a good thing, but they had 9 guys from the same fraternity, all roughly the same age, no diversity on the board at all. And they would get together 3 or 4 times a year for a football game or basketball game, and they would try to time the market.
Great strategy, right?
Yeah, great. And the technical term is they stunk.
Yeah.
In fact, they stunk so badly that the guy right across the street behind us, Julian Robertson, had stepped off the board and said, guys, you are terrible at this. So just give me 5% of the endowment and I'll manage it and do great things. He actually turned that 5 into 17. More on that later. But they really needed help. And so the chancellor at the time, Michael Hooker, one of the most visionary guys I've ever met, said, come to North Carolina, help us build this. And I use the basketball analogy since it's, the mecca of college basketball. I got there the first year and everything, reverse tomahawk slams. Everything we did looked like a genius. Now, not because we were doing anything smart, but just because things were really broken. Second year layups, third year free throws. Fourth year had to take a jump shot. It wasn't until the 5th year we had to take a 3-pointer. So we went from basically me to a team of 8 investment professionals over the course of 7 years, built out the back office. We actually spun ourselves out of the university into a private management company and did some fun things.
For those that don't understand, explain the difference between having the endowment inside of the school versus the management company outside, because a lot of schools have kind of pivoted to that model, and just what the difference is.
Yeah, it's an important difference. One of the funny things, so I get down to North Carolina and we start to do things like introduce an investment policy. I mean, you're laughing. They didn't have an investment policy statement.
I'm laughing because I know this story and it's fantastic. So you have to tell the whole story.
Okay, so the crazy thing is, so I come in and I will admit I was a little raw. I was young, and I was 34 years old, and I didn't really understand politics. And so the first thing I did is I did my first 100 days report, like the president does. And I said, here are 40, recommendations. Now, what I should have said was 40 observations, because recommendation implies that they were doing something wrong. So they took it negatively. So I got a little chastised for that. But the second thing I did is I introduced this idea of an investment policy. Again, not a novel concept, and everyone had one. And so I started January 1998, all through 99. Things were going well. We were super long, super strong, super concentrated in small caps and international, and we crushed it. And what people forget is back in the fourth quarter of 99, the Fed actually put $500 billion, back when $500 billion was a lot of money, into the economy to try to ward off Y2K. Everybody was afraid that literally the world was going to shut down on December 31st, 1999. And so we did really, really well, and we got really overweight domestic equity, international equity, small caps. And so I go into the board in February of 2000, and we had this board meeting, and a lot of things were happening. One, stocks were super overvalued, and the forward projected returns looked really unattractive. And I showed this chart from GMO, Grantham Mayo Van Artelu, and it showed that the expected return for U.S. stocks for the next decade was minus 1.9. And my board chair said, Mark, that's impossible. That could never happen. And in fact, you're not allowed to use the letters G, M, or O in a sentence ever again because this guy's always wrong and he's going to be wrong. And I said, all right, okay, fine. But our policy says that we're super overweight U.S. stocks. We need to trim back to the policy guidelines.
Basically, what you're talking about is there's an investment policy that had certain targets of asset allocation, and you had made investments. They'd grown so large that they had gone outside of those boundaries.
Yep.
If you follow the policy, you rebalance. But if you are going to meet up with your buddies and make stock picks, then keep doing what's working.
Keep what's working. And the thing is, no one likes to rebalance.
Yep.
Everybody likes to think trees are going to grow the sky and what's going to work yesterday is going to work tomorrow. And we actually know in hindsight that's not the way it works.
Of course.
And you should definitely rebalance. So I go into this board meeting and say, hey, it's time to rebalance. Now, are you kidding? These are our best managers. Why would we take money away from them? I said, because that's the policy. That's the discipline. And they're like, you know what? We don't like this word policy. You introduced this idea of policy. We're the board. So I want you to change that word from policy to guideline. So I had to literally go to the lawyers and change it to investment guidelines. So another meeting in May, and now I said, you can't do anything. So in May, the market started to roll over in March, starting to go down a little bit. The tech wreck was just starting. And they're like, all right, fine. You can go to the top end of the new guidelines, but no more, because these are our best managers. No way we can take any money away from them. And I come back in September, and they're like, get this shit out of here.
Yep.
And, oh yeah, change that word back to policy. And I'm like, okay, good. So now they got it. And we went on to do a lot more active rebalancing and a lot more discipline. And in fact, over the next couple quarters, we rebalanced the portfolio from long and strong to very hedged. Because by the middle of 2000, end of 2000, into the first part of 2001, we were starting to come up on a recession. People didn't really see it coming, actually kind of like now. And we said that it was time for getting hedged. And so I go to the board meeting, I say, all right, we want to add hedge funds. I'm like, well, that's going to be a problem. I said, well, why is that? I said, well, we banned hedge funds. Said, what do you mean you banned hedge funds? Well, back in 1996, Julian Robertson, again, had taken the assets from the portfolio and he had grown them to a really big weighting, but he had a bad year in 1996. He was down 9%. The market was up a few percent. And Businessweek wrote this article called The Fall of the Wizard. And it basically said that Julian was washed up. He'd never be good again. He was up 100% the next 12 months, but who's counting? And so I said, well, that seems like a really bad plan, but okay, fine, no hedge funds. So we'll have no hedge funds. We'll have opportunistic equity, long short equity, enhanced fixed income, and absolute return. And the chancellor looks at me and says, that's just nomenclature, right? I said, yeah. He says, good, as long as we're clear. And so we did go to 60% in those 4 strategies over the next 12 months. And from 2000 to 2002, markets fell almost 60%. Average endowment lost 25% of their money, and we were flat. Mm-hmm. Now I say I'm never going to break my arm, pat myself on the back for not making money, but flat was good when the rest of the world was down a lot. Mm-hmm. And it taught me the value of discipline, following your policy, the value of hedging, the value of not really focusing on past performance, but focusing on what's going to happen in the future. And really focusing on talent. Because at the end of the day, what we were doing is we were concentrating the portfolio in the most talented people. Mm-hmm. And it worked out really well. And because of that, in 2002, I got approached by a couple wealthy families that hadn't done as well during the downdraft. And they said, hey, come be our CIO. I said, well, that's interesting, but I'm not sure I want to work for just one family. But hey, I could create a business that could manage money for lots of families. Mm-hmm. And so we set out to do that. And we had this idea to create this company. Came up with lots of names, and all the good names were taken. All the birds of prey, all the big cats, everything was taken. So a lawyer finally said, hey, if you name it after a physical place, then you can use it. I said, all right, well, I live on Morgan Creek, so what about Morgan Creek? And my house was back up to Morgan Creek, and Morgan Creek runs through Middle Chapel Hill. It's actually the creek that James Taylor grew up on with his family when his dad was the dean of the medical school. And the song Copper Line is all about Morgan Creek. So if you look at our card and our logo, it has a little copper line through it, a little nod to JT. And so we decided to leave, or I decided to leave. So I went with these 2 families who set up Morgan Creek. And the idea was to bring the endowment model of investing to families, high net worth individuals, smaller institutions that didn't have staff and resources.
Explain what the endowment model is for those that don't know.
Yep. So the endowment model of investing is really pretty simple. It's a model that says if you think about investing, there's only 4 ways you can make money, right? They all require you to take risk. So you can take credit risk. You can buy a bond, and a bond, if they don't pay you back, you can sue them. So it's a contractual claim. So you don't make a lot of money for bonds above risk-free. Then you can take equity risk, so stocks and hedge funds. The idea is you get paid more for that because it's a contingent claim. You only get paid if the bondholders get paid first. And then you can take illiquidity risk, so private equity, private real estate, private energy, private debt, and you get paid more for illiquidity because you're willing to lock your money up for some period of time. And then there's structure, which is just a fancy term for leverage or derivative structure. And what the endowments figured out was bonds really aren't going to work for me because I need to make 5% real, meaning 5% above inflation to pay my spending. So I need to take more risk to achieve that. If I'm only make 2% real in bonds, that's not going to work. So I'm going to have less allocation of bonds. I'm going to have more allocation to equities, long-term equities. But then within equities, there's all kinds of equity, right? There's private equity, there's real estate equity, there's commodity equity, there's stock equity. So I'm going to take advantage of this illiquidity premium. And that means I'm going to have a high weight in private investments. And then I'm also going to have a value bias. And I'm going to have discipline. I'm going to follow this policy. So all of these things are what the Yale model and the endowment model were all about. And if you look over the last 20 years at that time, the endowments and foundations had outperformed everybody by a wide margin. We're talking 300-400 basis points per year compounded for 20 years, which is a lot of return. And it was really from the simple having a policy, having discipline, focusing on talent, focusing on illiquidity premium. And then the last thing, and we'll probably talk about this more later, is this idea that innovation as an asset class is really important, and that always backing innovation, back like when we backed Google at Notre Dame or other companies that did interesting things. One of my favorite stories about that is there's this great story about a company called Sienna. And back during the recession in 2001, this guy gets laid off from Bell Labs. And he says, hey, can I take my project with me? And then people are like, I don't know what you're working on. Okay, fine, take it.
Knock yourself out.
And knock yourself out. And so he takes it, and no one would back him. And he had this idea that he was going to shine light through a prism. and that would break the light into multiple colors, and each color of light should, in theory, be able to transmit the same amount of data as white light. So fiber optic cable could be expanded without having to add more cables. And no one believed him except this retired school teacher who gave him $300,000, which was probably her life savings. Now, the cool thing is it turned into $300 million for her, so that's cool. But he created this company which went on to change the way information flowed around the world because you could now increase the capacity of fiber optics. But that was innovation, right? That was thinking differently, or thinking, not even thinking like out of the box, but thinking like there is no box, coming up with a whole different way of attacking a problem. So this endowment model and this way of thinking, be a value investor, really resonated with a lot of families. We grew the business. The term outsourced CIO really didn't exist. In fact, we might have even coined it in our original presentation, OCIO. But we did something that in hindsight was dumb. We picked a good business, but a bad business model.
All right, so first let's talk about what the business itself. So the OCIO model, explain the difference between when you're an endowment CIO, you basically manage the capital that the endowment has itself. When you get approached by these families, the initial pitch is basically come work for us, right? Come run our investment arm. So you are working for a single pool of capital. The OCIO model is doing variation of that, but now you're doing it for multiple pools of capital simultaneously, right?
And before I answer that, I'll actually answer the original question you asked me, which I do all the time. You ask a question and I'll just go down some rabbit hole. But you asked the question about why was it important that we spun out of the university? And this is an important question in the sense that universities for years were run by teams of people internally. Most of them were kind of pretend CIOs. They were like the accounting office that started to do it, or back at Notre Dame before Scott and I got there, it was literally a priest who once a year he would go to New York, and whoever bought him the nicest dinner, he would allocate them some money, and that's how he did it. And he was a nice guy, and but he wasn't an investment professional. And the problem is,
he's a steak expert.
Yeah, exactly. He's a steak expert, and at a play, he was good at Broadway. And I said, really nice guy. The funny thing is, he actually got the job, this greatest title ever, as Procreator General at the Vatican, which is like the top finance guy at the Vatican. Interesting name. But what's interesting about it is, if you think about the pay scale at a public university or any university, it's pretty low. And so you're not going to attract the best talent. And so you're doing the best with what you can. And so there are two ways you can fix it. One is you can allow people to consult, like a med school prof that sees patients on Fridays, or a dental school prof that drills teeth on Wednesdays. So one of the things they did for me is they said, okay, you can consult, right? We'll pay you, your salary, but then you can consult to wealthy families. And I did that, and it supplemented my income, which was nice. But the second thing is, when I went to hire my first guy, it's amazing. So I found this guy, and he was a Moorhead Scholar, which is the top scholarship at UNC. We'll probably talk more about that kind of stuff later. But he was amazing, right? He was being recruited by Goldman Sachs. He had been voted Greek Man of the Year. I mean, really impressive guy, top of his class. And I wanted to hire him. And he was willing to stay and work for us for $35K instead of $50. This is back in 1998. And because his girlfriend was a year behind and still at school. And I go to the university and say, okay, I want to hire this guy. And I said, well, you don't have that position. I said, what do you mean? I said, I just want an analyst. And I said, well, what do you mean? I said, well, an analyst, an investment analyst. I said, well, you don't have that position. I said, well, okay, but the state, has an investment management firm, and they've got that position, and I could just borrow their position description from the state files, because you had to do everything through the state because we're a state university. And they said, well, they manage money. I'm like, well, what the heck is our $1 billion? They're like, well, but you don't physically manage. I'm like, oh, we allocate to other people and they manage, but we're still managing money. Make a long story short, they wouldn't assent. They said you could pay him $22,000. I said, but I won't get him for $22,000. I need $35,000. I said, sorry. So the attorney, the guy who helped me with the guidelines thing, said, hey, there's this thing. If you hire someone as a consultant, then you can pay them whatever. So we literally had to sell him to a temp services agency and then rent him back. And we paid $35,000 plus 15%. So we ended up paying 15% that we shouldn't have, but we were able to hire him. And so getting talent is really important. And what Yale and Harvard, and Harvard's the epitome of it, is they spun the whole organization into a management company, and it allowed them to attract the best talent. So we followed suit, and Duke had done it. And if Duke does, then Carolina's got to do it. And so we spun into a management company, and it allowed us to hire better talent. So the same thing in terms of forming Morgan Creek is we knew that we wanted to have this investment company structure that would be then a resource to multiple families or institutions. And so like when I said Michael Hooker, who is the chancellor at UNC, was a visionary, the reason he got me to come to North Carolina was he said, hey, I have this idea. We could manage money for UNC Chapel Hill. Then we could manage money for all the other schools in the UNC system. Then we could manage money for other public universities around the country. Heck, then we could manage money for the alumni. We could create mutual funds, and then we could take it public. I'm like, that is a guy I want to hitch my cart to his horse. Unfortunately, he passed away 2 years after I got there unexpectedly from cancer, and the board never really bought into his vision. They're like, well, we don't want to share. I'm like, it's not sharing. If we manage other people's money and we charge a fee, then we have more resources, then we can hire better talent, then you get better performance. It's a self-fulfilling prophecy, but they didn't see it that way. So I moved into this model where I could say, all right, we're going to build a resource, a management company, and I brought most of my team from Carolina, hired a couple of the guys I had my eye on, and I said, all right, we're going to build a shared resource, an outsourced resource. So you could hire us to be your team, and for the price of maybe one person, you could get a whole organization and a better team. And it was a way of building access to talent in a way that really hadn't been done before. So it was great. And the mistake we made, though, in the business model was the model we chose, OCIO, outsource CIO, doesn't scale. It's a great business, bad business model, because if you say I'm an outsourced investment office and you're going to have account reps, like I have 10 people I serve and you have 10 people you serve, the problem was every time I'd say, okay, Mike's going to be your person, they say, no, it says OCIO. You're the CIO. I need to see you. Well, I can only see like 15 people. So we capped our growth. Mm-hmm. Whereas other firms like Cambridge Associates and Northern Trust figured out if we have more equal-based people, senior investment people, but not the CIO, then we can have lots of people, have 10 people, and we can scale to hundreds or even thousands of clients.
Because it basically comes down to what people think they're buying, right? Are they buying an office? Are they buying the CIO? Are they buying some other resource? And it's almost like you did such a good job selling them on this, you're buying the outsourced CIO, that they said, well, where is he?
Yeah, where's the guy? Have him show up. And
sure.
And look, it was a great run, and we really enjoyed it. We still have some of that business today, 15 years later. Hard to believe it's been 15 years, but
Morgan Creek just turned 15.
Just turned 15. We just celebrated our 15th anniversary, which was pretty cool.
Absolutely. All right, so you do the OCIO stuff. Obviously, you start to realize, hey, this is great, but I want you to tell a story about how you get from the OCIO model to more of kind of a dedicated fund model.
Yep.
And some of the challenges of tracking down wealthy people.
Oh, no, it's great. So, we start with these handful of families, and then grew that to a number of families. But we launched in July of 2004, and November, that's when Thanksgiving is, November of 2004, literally we're trying to get a deal done for $1 million investment in an energy fund. And we had to track down the patriarch of this one family on a yacht in the Mediterranean, trying to use faxes and ship-to-shore radio, and realize this is stupid, right? So we need to have a vehicle where we have discretion. Because one of the challenges of investing with talent, the best hedge fund managers, the best venture capital managers, when they give you access, you have to take it. You don't have time to go, touch everybody and ask, do you want this or not want this? Because you have to then educate, this is the best person. When Blue Ridge opens up, they got a small window, you need to grab that capacity. And so we said, all right, here's what we're going to do. We're going to create these commingled vehicles. And so for hedge funds, for private investments, for venture capital, real estate, we're going to create these commingled pools, and all the families are going to participate in those. If you still want to have custom hedge funds or custom individual funds, fine. But the bulk of the exposure's got to be in these commingled vehicles. So we set up, Morgan Creek Partners to do private investments. We set up the Opportunity Fund to do hedge funds. We set an absolute return fund. And we did these commingled vehicles or fund of funds. I like to call them manager of managers because we were actually managing the portfolios. And we had a unique model in that 75% of the money was with external managers. 25% was with co-investments. And we would co-invest in deals or in individual ideas side by side with the managers. And that turned out to work really, really well. And so over time, some of our biggest investors said, hey, we love what you do in fund of funds, but what we really love is this idea of co-investing. And so we created co-investment vehicles. In fact, you and I met through a co-investment that we'll probably talk about later. And what was interesting is, at first, people were resistant, right? Because they felt that they were going to lose control. They wanted to make individual decisions. And what we got them to realize is it wasn't the individual decision of whether you're in manager A, B, or C. It was, are you moving into energy at the right time? Are you moving out of stocks at the right time? Are you moving into venture capital at the right time? Are you going into tech or healthcare? And so once they got comfortable with that, and once they had a relationship that they felt comfortable with, we moved them towards that business. But it was really this idea of accessing talent. And I say all the time that I literally, for most of my career, 30 plus years, I've had the best job in the world. I get paid to go around the world and talk to the smartest people in the world about investing. How awesome is that? I mean, literally, I've talked to Nobel laureates. I've talked to, some of the greatest investors of all time. I've been mentored by some of the greatest investors of all time, like Julian across the street. What a blessing to spend, a decade or more with that guy. I could go see him anytime I wanted. He would give me ideas. He would give me, philosophy, and he'd give me instruction. He'd tell me when I was wrong. But you learn so much by going out and interacting with really talented people. And it's also pattern recognition, because if you don't see everybody in the business, then you don't know what's good and what's bad. In fact, a good story about that, one you might not have even heard. I don't know. You've heard most of my stories, but this one might be unique. So the first family that hired us, one of the challenges they had is they had a really bad experience in private investments. Well, the reason is, very simply, is back in 2000, right before they hired us, they had met with 34 private equity groups, and they had hired 17 of them. Now, they committed 3 deadly sins in investing, and I'll ask you which one was the worst.
All right.
So was the worst that they only met with 34, okay, because there were actually 450 in the market that year, but they met the 34 that Credit Suisse and Merrill Lynch brought to them, because those are their marketing people? Or was the worst sin that they had hired more than 50%, where you should really only hire kind of 1, 2, 3% of the people you see? Or was the fact that the 34 they saw were all tech, because tech had done great, 96, 97, 98, 99?
So I'm going to go with option 3 as the big mistake.
Yeah, it's a big mistake, very big mistake. And I wouldn't tell the story if it didn't have the ending I want, which is, it didn't work out. And it made them realize that, one, they needed someone to help them understand that you shouldn't chase the hot dot. You shouldn't just go with what's been good. You've got to actually look. I say all the time, the best performance comes from people who have a great long-term track record, who've just gotten their butt kicked, and they just had a really tough period. And that's when you want to buy them. And
well, what you're talking about, there's 2 pieces here. So one is, if you were to ask many great venture capitalists, et cetera, would you rather bet on the team, on a specific company product, or the market? They're like, look, a great team is actually really advantageous, and kind of that talent you're talking about. But if you invest in the right market, you can actually invest with a bad team, and the tailwinds will take care of a lot of the faults, right? It'll kind of cover that up. If you invest with a great team in a horrible market, good luck, right? Even the best teams in the world, just if there's not customers or if there's not whatever. And so it's similar to the asset allocation of, are you in the right assets? Yes, you still have to go do the work on the managers and the right strategies, et cetera. But a good portion of it is just simply in the right assets, or in direct investing in private, just actually in the right markets.
Look, being in the right place at the right time is everything in investing. And I do think that founders and teams can make a big difference, and that talent ultimately wins. And I'm sure we'll talk more about that. But to your point, when I first got to UNC in '98, literally my first board meeting, right? I've been there 7 days. I go to a board meeting, and at the time, there was this famous cover of The Economist magazine, and it basically said, "The world awash in oil." And it was a picture of these oil guys on the front trying to stop a gusher from flowing. And they were covered in oil, and in the article it said that oil was about $11 at the time. It said oil was going to $5. And it actually had a line saying, "Someday oil might be free." Okay, so I go in, and again, we just had our new policy implemented, and I'm saying, okay, with our new policy, put a 5% target to energy and natural resources. We have 0, and I want to give 1% to this firm called Natural Gas Partners, even though they really did more oil and gas. There was 3 guys trained by Richard Rainwater, one of the famous investors of all time, out of Texas, and I make the pitch, and the board chair says, "Mark, that's the dumbest idea I've ever heard. But if you really want to do it, okay." And I'm like, "Great, awesome, okay." And the rest of the meeting goes on. He calls me in the chancellor's office after the meeting, and he says, "Mark, when I say that's the dumbest idea I've ever heard, that's what I meant. The rest of the stuff was just to be nice in front of all the people because you knew it." And the chancellor says, "Well, Max, right? I mean, if we're not going to take his ideas, we should just fire him right now. But if we're going to take his ideas, which I think we should try at least, I mean, we just brought him down here, maybe we should try a couple ideas. Then if they don't work out, we can fire him." I'm like, "Guys, I'm sitting right here."
I'm on day 7.
Talking about firing is not interesting to me. What's interesting is they did let us put 5% in energy. And that 5% in energy generated 25% of UNC's returns the next decade. Again, not because I'm a genius, but because we were in the right place, right time. We partnered with great people, Merit Energy Partners and Natural Gas Partners and a few others. But to your point, it was really about being in the right asset.
And I also think not only is it the right asset class, right market type stuff, but one of my favorite sayings that you have is about timing. Right. Yeah. And this idea of people buying and selling things maybe when they shouldn't. So maybe go over a little bit of your framework. I mean,
it's everything to what we talked about up to this point on the board, right? Is there's this great piece by Barton Biggs that he wrote, 2 pages. He was a famous strategist for Morgan Stanley. And he wrote this thing called Group Stink. And it's the best 2 pages I think I've ever read about the psychology of investing and why there's truth in this idea that an investment committee should be made up of an odd number of members, and 3 is too many. So groups don't make good decisions. Groups, particularly boards, make really bad decisions. And why is that? It's not because they're not smart people. They're incredibly smart people. That's why they get to be on the board. But once you get on the board, what's the most important thing? To stay on the board. And so what you do is you make decisions that are homogeneous and that aren't controversial. And so I used to keep track, and when we would recommend stuff to the board, about 95% of the time they would approve it. And the 5% that they didn't approve were by far our best ideas. And that's not a criticism of them or saying we're geniuses and they're idiots. No. Just the opposite. We were kind of being idiots at the time because we were really pushing the envelope, and the things that sound the craziest at the time, the things you get the most pushback, are usually the best ideas because they're really pushing the boundary or the edge of the opportunity. And so when my board chair says, "Mark, that's the dumbest idea I've ever heard," well, that's the trigger. Ding, 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 ding. That they do ring a bell when it's time to go, because when everybody's telling you that something is terrible. That's one thing I love about Twitter, right? Is I can put an idea out there and I get instantaneous vitriol or hatred. I'm like, ooh, that's a good idea. If everybody says, oh, Mark, that's the greatest thing ever, geez, okay, that's already in the market. And so...
Well, and a lot of it's coming from it's probably something that's either controversial or pushing the edge, is something that not a lot of other people are thinking about or doing. And so if you're able to do something that other people aren't doing and it's right, that's where a lot of the returns end up being anyways.
Oh, come on. It's my pinned tweet, right? The greatest wealth is created by investing in something that you believe in before people even understand it. And that has been true forever, right? From the early days of when, the idea of carried interest was started. Queen Isabella sends Christopher Columbus off with these ships, and she says, I want carried interest. Well, let's think about that for a second. 20% of profits. The stuff they carried back in the ships, she got 20% of. So she was a venture capitalist. And no one thinks about her as a venture capitalist. And actually it even goes back further than Queen Isabella, in that if you go to Greece, where I know you were last summer, and you go down the peninsula, there's a very thin point where I forget which, the Corinthians built a track. It's 7 miles long, the narrowest point. And if you went down around the Panoply, I can never forget how to pronounce it, but when you were sailing back in the early days, it was really treacherous. And so literally people would pull into port and they'd load up the boat on this track, and the slaves would push it across the isthmus, and you get to the other side and you'd be safe. Well, there was a carried interest, meaning they took a percentage of what you had in the boat, probably made it lighter too. And so that idea of sharing the wealth came from an idea that no one had really thought about, or again, thinking outside the box. But in terms of investing and timing, it's definitely clear that the best investment ideas are the ones that are the least popular.
Well, I think the one saying that you say all the time that it cracks me up because it's so true is about people basically buying the things that they should have bought and then selling the things that they need.
Come on. It's so easy to do what everyone else is doing. And when is it easy to do what everyone else is doing? Well, after something's gone up. So human beings do two things really, really well. One, to your point, is they buy what they wish they would have bought. And we're spectacular at it. And it's true of everything. It's true of fads, right? People buy the hot piece of clothing right at the end of its life, not at the beginning when people would say it looks stupid. And then it doesn't have a good, useful life. Or they buy an investment after it's already gone up. Back in 2000, we set the all-time record for money flowing into tech stocks in 3 months, January, February, and March of 2000. Not in 1980, right, when the cover of Business Week said the death of equities and stocks were super cheap and you could have bought all the equities in the United States twice with all the gold in the world. No, nobody bought stocks then. They waited 20 plus years until they had gone up, and they had gone up a lot, and people piled in and bought Cisco at crazy prices and then watched it fall 90+%. And so human beings are spectacular, buying what they wish they would have bought. But the second thing they do, which is equally bad, is they sell what they're about to need. And so, you look at let's take energy right now. Energy stocks are on their ass. Everything is everyone's hates energy, and electric cars are going to be the next great in 20 years. It's going to take a long time to get rid of the internal combustion engine. Even if we should get rid of it faster, it's just going to take a long time. And so oil is going to be with us for a long time. And there are a lot of oil companies that have just gotten obliterated, and everybody's flowing into FANG. And I say, right now you should be selling FANG, Facebook, Amazon, Netflix, Google. You should be buying FANG, Diamondback Energy, because nobody wants to own it. Same thing with hedge funds. Hedge funds have underperformed during the QE era. They've had a horrible performance because it's tough to short stocks. Because the idea of shorting is you're supposed to sell short companies that are bad. And usually companies that are bad go out of business. But if you artificially suppress interest rates and make money free and allow companies that have no business borrowing money to continue to borrow money to stay alive, then shorting stocks is really hard. And so hedge funds have struggled But right now we're at the precipice of a really tough period in markets where you're going to wish you were hedged. And it's just like back in 99, 2000, 2001 when I was at UNC and telling them they need to get hedged. They're like, no, I want to give money to Tom Marsico because he's been up. Like, well, right. And the fact,
I think part of it is, it goes back to, when you're sitting there, you're saying, look, equities over the next 10 years, negative 1.9%, and they're saying that's impossible. Right? It is, humans are very revisionist in history, right? In terms of when they look back, it's, of course, this is going to continue, right? And they will even say things like, well, it won't continue forever, but it's going to continue for the next 5 years, or the next 10 years, right? It's this, the market shift, or I think, Ray Dalio recently wrote this thing about paradigm shifts, where timing those are really difficult, but actually kind of looking around the room is a great signal as to when maybe I should be thinking differently than everyone else in this room, because they are so excited that if everyone is excited, it may pay to actually not be as excited as they are.
Yeah, it's really interesting too, because you hit on a really important point, and it's subtle that people don't think about, is doing the opposite of everybody else all the time is a really bad strategy, right? And Soros has a great quote about this, is that the trend actually is your friend. The only time it's not is at inflection points. And one of the things that's interesting is you don't want to just resist the market's movements or the trend, or whether it's a secular move or a cyclical move, just to be contrarian. So being a contrarian for a contrarian's sake is a dangerous strategy. But what's really important is the subtle point you said, is when you're looking around the room and suddenly everybody is leaning one way, or everybody's on one side of the boat, that's when it starts to pay to start walking towards the other side. Not necessarily right away, but pretty quickly. And making those decisions at inflection points, and people say, well, how do you know when there's an inflection point? Well, inflection points are really cool in the sense that they advertise themselves. It's like a phase shift, back to chemistry. It's like a phase shift between water and ice, or water and steam. Is what happens is right before that shift, the atoms start to vibrate very rapidly. And the same thing happens in markets. Markets have low volatility during a trend. And then what happens is they start to have really high volatility. So if you look at, just take last week in the equity markets, we were up 3%, up down 1%, up 2%, down 2%. And that volatility tends to spike right as things are about to shift or change.
For those that are only used to the crypto markets, those are big movements in the equity world.
Yeah,
in
exactly.
crypto, that's like an hour, but
exactly.
But huge deal in the equity markets. Exactly. So another piece of this, I guess, is you said it. You don't necessarily need to shift immediately, right? So when you kind of get that the gyration of the markets, or the volatility, the other thing that I see a lot of people, especially right now, given that there's some people yelling and screaming, saying, "Hey, there's some gyration going on," is you don't have to go from long to immediately 100% short either, right? There's an element of making a move to cash, for example, is actually a decision. It is an investment, right? And what you're doing is you're basically taking risk off, and you are not necessarily betting on the inflection point, but what you're doing is you're hedging yourself to some degree. And when something does happen, right, let's say the markets do roll over, the people who have done that have actually positioned themselves the best, because they're the ones who have all the liquidity and can buy when everyone else is selling.
Again, such an important point. And if you think about the greatest investors of all time, they are very judicious in their use of cash, and they don't view cash as not an investment. The industry has gone to this point about, unless you're fully invested, you're not a real investor. Well, no, that's silly. Cash is an investment. It's a choice, to your point. And being short is a really tough business. Shorting companies, John Griffin, who ran the famous hedge fund Blue Ridge, described it best. It's like playing chess. If you try to short during the opening, there's three phases of a chess game: the opening, the middle game, and the end game. If you try to short in the opening, it's just a waste of time, because you have no idea. You and I start a chess game. We have no idea who's the better player at the beginning. It's just a waste of time. In the middle game, where the strategy is coming and the big moves are being made, that's when it can just be lethal because it can go against you really badly. It's only in the end game, right, where you know who's going to win when you want to short. And so you get signals in equities as to when that end game is occurring. And I'm sure we'll talk at some point about Tesla and all that. But I think about this all the time in that if you think about cash, I even have a hashtag for it, cash is king, that I like hashtags, by the way. Cash is king in that the reason it's king is it has very high option value. And somebody, I can't remember who it was, it'd be better if I could remember, give them credit, but they call it market Valium because it takes the stress out. If you're fully invested or fully short, you have stress, right? And if it goes against you, you might make bad decisions because you're trying to stop the bad things from happening to your portfolio. Whereas in cash, you just get the ability to sit back and watch and observe. And then to your point, when you have liquidity, when no one else does, you win. I mean, think back
It's the kill shot. Pardon? It really is. It's the kill shot, right? In markets where if nobody else has liquidity and there's a liquidity crunch and you're the one sitting there with liquidity, you dictate.
Well, you not only do you dictate, you get to buy all the best assets because no one else can buy them and you can. They're at the perfect price, a huge margin of safety. You get all the upside. And you also get flexibility in how you structure. It's kind of like, after the global financial crisis, who was there with lots of cash and he didn't even buy stock. He bought convertible bonds, Warren Buffett, because he got the first call. And why did he get the first call? Well, who had enough cash to bail out Bank of America or Goldman Sachs or, any numerous other deals that he did. And
it's funny, the people who have bailed out the government or bailed out banks, they always are the wealthiest with lots of liquidity.
Oh, come on. I mean, one of my favorite stories, right, is you go back to the last time the banks were threatened. Okay, 1907, you had this thing called the Knickerbocker Panic. And what was the Knickerbocker Panic? Well, the trust companies were trying to create alternatives to banks. And there's this guy, J.P. Morgan, you might have heard of him. He didn't like that so much because he was the banks. And he basically started a rumor that some of these trust companies were insolvent and that you better get your money out fast. So he literally triggered a bank run, the Knickerbocker Panic of 1907. And these trust companies all started to falter. And magically, he and John D. Rockefeller, one of his good friends, were able to pick them up at a very bargain basement price and get rid of the competition. And then they went even further. And it turns out John D. Rockefeller's dad or father-in-law was Amory Aldrich, and they came up with this plan to create the Federal Reserve Bank. And it took them 4 years, from 1909 to 1913, to actually get it passed. They call it the Jekyll or the Monster of Jekyll Island for a reason. One of the worst things that ever happened. But unless you're a banker, because it was created basically to keep the bankers rich, and it's done a really good job at that. And but when you have liquidity, right? When you can write a $25 million check, when that's a lot of money back then to save the banking system, so to speak, even though you created its demise in the first place. But it's what is it? The arsonist who sets the fire and then shows up as the fireman and pats himself on the back. We have somebody who's doing that in other places.
Yeah.
But it's really interesting over time when you think about this idea of liquidity and having liquidity at exactly the right time is how you make the biggest returns. And Stan Druckenmiller has a line about this. He says, the way you make big returns is preservation of capital and home runs. Well, how do you preserve capital? Well, one, you avoid buying overvalued assets. Two, you don't reject the idea that cash is an asset and can have huge protective value because you can't be wrong, right? You own cash, you're not going to lose money on it. And then third is this idea of home runs. Is how do you get home runs? Well, when you get an edge, my big thing in my Twitter feed is #edge. Well, when you get an edge, whatever that edge is, you have to have the courage or the guts to really bet big. And you think about when Druck was with Soros and all the things they did when they had an edge, whether it was with the pound or whether it was in a certain company or a certain asset class. And they would wait patiently with lots and lots of cash. They would preserve capital, and then they would pounce. And the other thing about this that's really interesting, and most people don't understand this about investing, but preservation of capital is really important. And it's what differentiates the real long-term winners from the losers. But the thing that separates the really great investors from the just good investors is the uncanny ability to double up and to press the winners.
So I want to make sure that we talk about this because I've talked about it before on the podcast. One time I asked you, I said, what is the biggest difference between the top 5 best investors in the world and the top 1%? So I wasn't interested in, what separates the good from the not good or even the great from the good, but the absolute 5 best from the really, really, really good, right?
Yep.
So basically what separates that 5 best from their peers? And you said to me,
well, it's that ability to double up, to have courage.
I think your specific statement was they cut their losers faster than anyone, and they press the winners harder than anyone.
Yeah, okay, yes. There are 2 parts to it. Thank you for reminding me. Yeah, that's exactly right. So, Soros has the line, right? I'm only rich because I admit my mistakes faster than other people. Mm-hmm. And what most people do is the exact opposite of what you should do. Is we water our weeds and we pull our flowers. As soon as we make a little bit of money, we pull the flower. I'm up 10%. I won. No, add more because it's going to continue to go. And what we do is when we're wrong, we try to justify, the market's wrong and I'm right, or I'm early, euphemism for wrong, and I'm going to be right later. And so the
dollar
great
cost
investors,
averaging down.
Yeah, and everybody said, I'm going to average down. Never, ever, ever average down. It's a horrible decision. And people say, well, Mark, you're a value investor, and you say all the time that you should average down. Well, averaging down is different than buying more of something as it becomes cheaper. Mm-hmm. The difference is when you're speculating on something, when you're buying something just on price and it moves against you, you're just wrong, right? When you buy something with a margin of safety and it continues to deteriorate because everybody else is puking it out, like the energy stocks today, then you've done the analysis, you have the edge, you have the ability to buy more. So some could nitpick and say that's the same thing. I'll grant that, actually. But
what you're talking about specifically is this difference between price and value, which I think that is very, maybe not very well understood, but well discussed in traditional markets. In the crypto world is almost a non-existent conversation.
Non-existent conversation.
Right. And what you're specifically talking about is if you're making investment decisions based on price alone, then you very quickly know you're right or you're wrong, right? And it's very easy to measure on a quantitative basis. When you are making a value-based investment, so not necessarily related to the price, but you understand what an asset is worth based on whatever that analysis is, and the price is below that value, the price movement is almost less important as is it still below the value?
Correct.
Right. The relation to the value is much more important than is it up 5 or 10% today or down 5 or 10% today, because you want to continue to buy the asset that is undervalued in price as long as it is undervalued.
No, that's exactly right, and really well said. We must have been hanging out together somewhere. But it's interesting in the sense that cutting losers is critically important, and the first loss is the best loss, and not trying to convince the world you're right and the market's wrong. But this real uncanny ability, and to me what separates the truly top 5 from everybody else is this uncanny ability to double up. And I said I had the luxury of having Julian Robertson as a mentor and friend, and he helped seed Morgan Creek when we got started. And in fact, a funny story is I got this email when I announced my resignation, and it said, "Say it ain't so, Julian." Like Shoeless Joe Jackson. And I joke, I don't get a lot of emails from billionaires. In fact, at that time, that was my first one. And I got a couple others since then, but that was the first one. And hit the bid. And I came up to New York and walked in the building across the street, went up to the 48th floor. And I joke, I thought I was going to get my Nike shoe deal. And people said, what are you talking about? I'm like, well, Nike shoe deal works like this, is the coach at the university doesn't make a lot of money from the university. He gets the money from his Nike shoe deal and television and radio and all this stuff, or an alumni slush fund. And so I figured that Julian was going to say, hey, Mark, I know we can't pay you enough, but we'll find a way to get you some more money. And instead I walk in, he comes out, he puts his arm around me, he says, Mark, I'm surprised you lasted that long. I like you and I want to work together. Like, I hit that bid. And so he got
better than a Nike deal.
Better than a Nike deal, way better. And but because I got close to him, I had the luxury, one, of then investing with all the great firms that spun out of there, from Blue Ridge to Lone Pine to Maverick to just dozens of firms, and got to know those guys. And one of the cool things I did is I would interview all of these guys on Julian, and I had these notebooks full of pages, probably write a book, on what made him great. It was amazing. Everyone had a different perspective. The macro guys would talk about his macro views, or the underlying guys would say, one of the favorite things about Julian, he said, never fudge the numbers. If you don't know, don't start talking, because he'll know. And the other one was just about competitiveness, right? If you're not competitive, you're out. And it doesn't matter competitive in what, right? It can be tennis, golf, tiddlywinks, equestrian, doesn't matter. Just he wants you to be competitive. And then the other is honesty and integrity. There's nothing else without that. And so, but the thing they all said, 30 plus of these interviews I've done, they all said he had this uncanny ability to double up. So when most people are afraid because they've made money and they don't want to lose it, he's adding to it. And that ability to see the future, it's the Jeff Bezos to say, I'm going to make this a world-changing technology. And people are like, no, it's a bookstore online. Who cares? Like, no, it's bigger than that. And it's the ability to ride with it. And here's the amazing thing about Amazon. So Amazon went public in 1998. So it's been public for 20 years. In every single year, including this year, it's had a double-digit drawdown. The average drawdown is 31%. So I say, how many people actually bought the IPO in 98 and still hold the stock today? That would be Jeff and his parents. That's it. Because everybody else got shaken out, because twice it was down more than 90%. But to have the ability to hold through that volatility, because you just have a belief and a passion in this being a great business and a great business model and a great investment, is really a superpower. It is an absolute superpower. And I've only had the experience on a handful of occasions over time. So I've literally met with thousands of managers. I mean, did 400 meetings a year for most of my career. People always call bullshit on them. I'm like, well, give me my calendar. Do it. And only a handful of times have I walked away saying, that person has it. And it is the ability to be a true believer, to really hold something dear that everybody else questions. And I remember having this conversation with a manager out in California, and we still invest with him today. And he worked at this firm called Integral Capital with this famous guy, Roger McNamee, kind of Grateful Dead kind of rocker. And Glenn worked with him, and it was amazing. And Google had just gone public and was starting to fall. And a value manager friend of mine said, Google's not worth $50. And it, gone public at 50, gone to 100, it was falling back. And I'm sitting there saying, I really don't know why you own Google, and you should really probably sell, according to my value manager friend. And Glenn looks at me and says, Mark, you're crazy. You just don't understand. This has nothing to do with value today. It has to do with what this technology is capable of and how it can be monetized in all these ways. And I listened to him and I just went, wow, okay, he's a true believer. And clearly Google it 1,000. Glenn was right and Richard was wrong. But that ability to not just own it and be happy just making some money, but to keep buying more of it and to really press those big winners. And that's where great fortunes are created.
Skirt, skirt. Want to know who has the best URL? Crypto.com. That's right, Crypto.com. They're a crypto platform with one goal: mass adoption. That's why we're all here. We're trying to get crypto in every wallet. Crypto.com is helping people do that through buying, earning, lending, and card payment. Everything you could want at Crypto.com. Go help your boy out. Tell him Pomp sent you. Download the app or visit Crypto.com. Pomp's got you, always. Ever wanted to get into mining and didn't know how? Don't worry, your boy Pomp's got you. Everybody got some electricity and Wi-Fi. All you got to do is go to coinmine.com. You buy a coin mine. It's like an Xbox or a PlayStation that helps you turn your electricity into Bitcoin. That's right. You purchase it, it shows up at your doorstep, you pull it out of the box, you plug it in, connect to your Wi-Fi, 5 minutes or less, you're mining Bitcoin. All you have to do is control it from the mobile app they provide, and then you receive over-the-air updates that add new coins and new features on a consistent basis. Kind of like how Tesla does over-the-air updates and updates the car software. Just you're updating your coin mine. Consumer mining made easy. That's right. Go to coinmine.com, tell them Pomp sent you, and thank me later.
It always cracks me up. The one saying that I love, which is you have to be very careful with, because if you're wrong, this works against you. But the idea that concentration builds wealth and diversification preserves it.
Yep.
Everyone knows the saying. Everyone is scared, frankly, shitless of deploying it, because you are increasing the risk of loss of capital if you're wrong.
Yep.
But you are increasing the probability of outpacing the returns if you're right.
Oh my God. Well, look, ex post, it's the easiest saying in the world. It is so easy after the fact to say, oh, concentration builds wealth. Of course you should have put all your money in Amazon. Of course you should put all your money in Apple. Apple at $7, when people were saying it was going to zero because they had nothing new and no real competitive advantage, and Microsoft was kicking their ass. That was tough to hold on at single digits. And what's interesting about that point, Pomp, is that if you think about, I love this screen so we can pop our peas on the podcast, and it doesn't sound bad. But if you think about this construct of concentration and diversification, right? I spent my life, I always talk about it in chapters. So chapter 1 is I work for not-for-profits. And I loved it, and it was great, and I loved the psychic income of getting up every morning and going in and knowing that we're making faculty's lives better and students' lives better and the university's better, and that was great. And then chapter 2 was building Morgan Creek and building this asset management business, and chapter 3 is what we're doing together in Morgan Creek Digital, and then chapter 4 is I'll teach. But what's interesting is, if you think about what most people think about me, is they think about me as this endowment investment guy. It's all about diversification, and what are you talking about, this concentration thing? And I'm like, no, what you're missing is, again, what I've learned about great investors, those top tier investors, is their ability to do a couple things. One is the willingness to concentrate. 2, being visionary to see where the puck is headed. Everyone says it's Wayne Gretzky. It wasn't Wayne. It was actually his dad. His dad. People said, "Why is Wayne so great?" He says, "Well, because he skates to where the puck is going to be, not to where the puck is." It was actually the dad. And the key is that those are requisite skills to be a great investor. Is you have to be visionary. You have to see the next thing. And you have to get out in front of it. And you have to be willing to double up. But one of the things that's really, really important is you have to be willing to be wrong. And so many people are paralyzed at the thought of being wrong. And Twitter's full of this, right? People go back and they'll search through my Twitter feed and say, you were wrong a year and a half ago when you said this. I'm like, what are you talking about? Of course I was wrong. I'm wrong all the time. But I don't stay wrong. Being wrong is fine. Staying wrong is not. And so great investors are wrong way more than bad investors. Because bad investors don't act. They're so paralyzed at the fear of being wrong that they don't make investments. And so they can't be wrong. But a great investor keeps trying things, keeps pushing the envelope, and when they're wrong, they fix it immediately, right? They do the Soros, admit they're wrong, move on to the next idea, because they've always got great ideas. The key is if you don't have lots of great ideas all the time, well, then you're not doing it right? You should constantly be looking and reading and thinking and talking to people and looking for great ideas and pushing that envelope and keep trying them all. And one of the things I love about venture capital investing is you want zeros, right? You want to put money into something and lose it all. People say, what are you talking about? That's not what a fiduciary does. I'm like, well, of course it is. Because if I make 10 investments and 3 of them go to zero and 5 of them are just but 2 of them make 10, 20, 30, 40, 50x, I win. And so that ability to be wrong, to be comfortable being wrong, I say it all the time, is my wife has said, that I'm frequently wrong, never in doubt. I'm like, well, occasionally wrong, never in doubt. Definitely never in doubt. And people say, well, how? In fact, my wife's only seen me speak one time, and I speak a lot. And I give speeches all over the world, and I've done it for years. And so she finally came. It was at a conference in Vegas, and she came and she sat in the back. And at the end of the speech, she comes and she says, "Oh my God, you can't say things like that." I'm like, say things like what? She says, "You say things with such conviction. Like you're sure." I'm like, well, what's wrong with that? She says, well, people will believe you. I said, well, that's actually kind of the idea. She says, but what if you're wrong? I'm like, well, then I'll change my mind. So strong opinions, loosely held. Mm-hmm. If you don't have strong opinions, if you don't have conviction, if you don't have courage, you won't act. Mm-hmm. If you don't act, you can't win. Mm-hmm. If you act and you're wrong, then fix it.
Yeah.
And then go to the next thing. And how do you get conviction? Well, you do the work. Most people don't want to do the work, right? They want to hear about a good idea. They want to hear. And great lesson in life, right? We all learn from our mistakes more than our successes. In fact, I keep on my desk, right on my desk, it's a little thing that says, failure changes for the better, success for the worse, from Seneca the Younger. And it's so true, right? When you're successful, you get lazy because you think it's you. And then you get caught off guard and you get smashed. When you fail, you learn. And another good friend of mine, great hedge fund manager out in California, has a great line. He says, with every investment, we get richer or wiser, never both. Because you don't get wiser when you're right. You only get wiser when you're wrong. And when you recognize that mistake, you acknowledge that mistake, you learn from it, and then you forget about it. That Ralph theory that Dean Smith used to talk about. So, recognize it, admit it, learn from it, forget it. And I had this first job. So I'm working at this Disciplined Investment Advisors. We have $1 billion, and people are calling us all the time, and the brokers are giving us hot stock tips. And so I had just gotten my rollover 401k from my first job, and I had a few $1,000s, and I was going to be a big swinger. And instead of doing what I should have done. So I grew up in Seattle, and a bunch of my friends don't work anymore because they went to work for this little company called Microsoft. Now, if you've ever seen the picture of the original 7, you wouldn't have gone to work with those guys. They look like freaks, but I should have gone to work there, like some of my friends, but I didn't. And so here it is, 1991, I had this money. All I had to do is buy Microsoft, Cisco, Intel, a couple other tech companies. I would have been set. No. This broker calls up and he's got 2 hot stock tips. And the receptionist calls me and says, hey, Joe says you should buy these 2 companies. I'm like, okay. So I take half my 401k distribution. I put it in one company. I put the other half. Concentration. I had done no work. I had done no homework. I didn't know this guy from Adam, but I was in this new job, and this guy had to be smart. No, he didn't have to be smart. He was trying to sell shit. Mm-hmm. And long story short, obviously, I lost my ass. Now, what's great is one of the stocks literally went to 0. But the cool thing about the broker that I used when something goes to zero, they don't take it off your statement. So every month when I opened up my statement, it was still there. And it was a great reminder, don't ever do that again. Mm-hmm. Don't ever take a hot stock dip. Do the work. And but I learned so much from that experience about if you're gonna take concentrated positions, if you're going to focus on an area, do your own work, find people who have real expertise in the area, and then follow them. Don't take hot stock tips.
So I want to talk about, as part of doing that work, this idea of innovation as an asset class. And, I think that what it really is saying is tying a lot of these ideas together of innovation is the things that are being built today that will eventually become the trend later, yep. Right? And so it's very early opportunities to get in front of things is yep. where the innovation is. Yep. And so this idea of innovation as an asset class, maybe describe a little bit about what you mean by that and how people should think about that as they think about investing and portfolio construction.
Well, you and I have talked about this a lot in that there's only 4 asset classes you can own, right? There are stocks, bonds, currencies, and commodities. And everybody else talks about all these other things. What about venture capital? What about private equity? What about hedge funds? I'm like, no. At the end of the day, I own a stock, a bond, a currency, or a commodity. Let's take private equity. In private equity deal, I own common stock, preferred stock, or a convertible bond. Well, what about real estate? Well, I own the equity of the deal, the debt of the deal, or the land, the commodity. What about hedge funds? Well, hedge funds, mutual funds, private partnerships, separate accounts, they own stocks, bonds, currencies, and commodities. I mean, a hedge fund is just a legal structure, just like a mutual fund. It's a legal structure. So I came up with this idea of innovation as an asset class, which is antithetical to what I just said, in the sense of, well, no, if you're going to invest in innovation, you're either going to own a stock, a bond, a currency, or a commodity. True, but the idea of innovation as an asset class is basically saying that I want to focus on owning, and mostly I'm going to own equity. I might own some convertible debt, but I want to own ideas, and I want to own the future, and I want to own big secular trends over the long term. And the way I came to this was, again, I've been blessed to have great mentors and have great relationships and really hang out with some of the best investors on the planet. And when you watch what they do, if you look at the best performing funds over the years, they share a couple common traits. One is they have a very high weighting in private investments, so they take advantage of the illiquidity premium. The second is they have a high weighting in venture capital. So what is venture capital? Venture capital is allocating capital to entrepreneurs who are going to build something, and it could be any number of things, but they're pursuing ideas, they're pursuing business models, they're pursuing innovation. And so as I experienced over time, I started with bonds. And bonds are just lending money to somebody, and you get a small fee for that, and it's a nice, safe investment. It's actually a horrible investment for a young person. In fact, I actually say it should be against the law for people under 40 to own bonds. We'll come back to that later. But people go, what do you mean against the law? I'm like, just trust me on that one. You should own no bonds, because the bond is really your future income stream. Think of that as fixed income over your life, and you can own bonds later when you're retired. The second is that equity is a claim on the cash flows of a business, and that's what makes it great. But what you really want to own is the innovation behind the business that's going to build new assets or new industries, and it can be things that are little e entrepreneurial or big E entrepreneurial. You have a great line that I stole from you guys, and people have heard me talk about this, that what I love about spending time together is from the very beginning, even when we didn't know each other that well, I say, it's like talking to myself, right? I mean, everything you do on Twitter, I like. I was like, wait, I would have said that. Wait, I might have said something like that.
That's scary. You see some of the stuff I say?
Yeah, that is scary. But I would say it's like talking to a younger, better looking version of myself. But what's cool is I stole this line that you talk about, that technology or innovation can do two things, right? It can make an old thing better, or it can make something totally new. Well, big E entrepreneurship, making something new, that's freaking hard. I mean, it's really hard. There's people who do it, and there are a lot of people who've done it, and there are a lot of ways to capitalize on it and make a lot of money from it. But literally entrepreneurship, making old things better is actually not as hard. And it's funny, when I first started thinking about leaving the university and starting a new business, I was trepidatious, and people would say, well, Mark, you're such an entrepreneur. I'm like, what are you talking about? I've worked in the safe environment. I work for not-for-profits my whole life. I'm the least entrepreneurial person on the planet. I said, are you kidding me? You created a management company, you spun out of the university, you built 2 offices, you helped build Notre Dame's office. You're totally an entrepreneur. I said, oh, okay. I'm a little E entrepreneur. I love to build things, but I don't want to try to invent things. That's not my thing. But
it's the one thing I think I've said this to you before is, I spent most of my life technology, startups, that world. And as I've learned more about the Wall Street, asset management, and kind of finance world, if you look around, every single person who is, one of these world-class entrepreneurs, they don't call themselves entrepreneurs.
Right.
They're all investors, right? Every single one of them has the identification of, I'm an investor, I'm an investor, I'm an investor. But you look and you say, you built a business that has, hundreds, if not thousands of employees, right? Or, 50 employees, and you've got all these assets, and you built a company. Yeah. It just might not look like a software-based company, right? Or it might not look like a restaurant or something like that. But it is a company. You did start it, and you did build it, and you can call yourself whatever you want. Yeah, but at the end of the day, you started a company, right? Yeah. And it's just one little nuance of the two industries where, you would never find a tech entrepreneur in building a fintech to say they were an investor. They're a founder.
It's a great insight again, and so true. And it really helped me when I got over this hump of thinking about it. It's like another thing that's funny. Someone said to me once, you're a great salesman. I'm like, I am not a salesman. I'm an investor. And they're like, no, you're a really great salesman. I'm like, no, I am not a salesman. I am an investor. And he said, well, no, you're just looking at it wrong. He said, sales is simply transferring your enthusiasm to another. I'm like, oh, dang, I am actually pretty good at that. I can get enthusiastic about stuff, and I can make other people enthusiastic. And that's ultimately how you build stuff, is you harness enthusiasm and you get other people excited and you bring them along. But this goes back to this idea of innovation, and whether it was Glenn understanding the innovation that was occurring inside Google, and that it was a better way to do search and a better way to, look, it's a verb. Mm-hmm. I mean, think about it, right? It didn't exist in 1996, and now it's a verb that I use every single day.
Crazy.
And so that's really astonishing, and the wealth that's been created by it. And it's why I get so excited about blockchain technology and Bitcoin and all the things that I'm sure we'll talk about at some point. But I've never lacked for enthusiasm about what I do. One, because I get to interact with such great people. Two, because I'm constantly exposed to these new ideas and these things that literally are changing the world, and change the world for the better. Sometimes, a little less for the better if they get abused or not used properly. But I just find so much intellectual stimulation and challenge in trying to intuit one, where that puck is going. What cyclical or secular trend should we be focused on? What area of innovation should we be focused on? And then how to get that innovation into our portfolio. And I'll just give you two quick examples. So if you think about, most people would tell you, if you ask them, who's the best investor in the country? They'll say, oh, David Swensen, Yale, number one. They're actually number three. That's not taking anything away from David. He's amazing. And Dean Takahashi.
Number three is pretty good.
Yeah, well, and Dean Takahashi, who's been the number two at Yale that no one ever talks about, it's like I always feel sorry for Caulfield and Byers, Kleiner Perkins, because no one knows Caulfield and Byers, but they're really good investors, but it's Kleiner Perkins, or sometimes even Kleiner, and they don't even talk about Perkins. But they were all really good. So Dean Takahashi doesn't get mentioned, but Yale's pretty good, and they've got 52% in private, and they've got 17% in venture and innovation. And that's fantastic. But the number 2 performing fund was actually Jeremy Grantham, contrary to my board chairman saying he's never right. His foundation and his asset allocation is even more simple. 40% hedge funds as a fixed income replacement, 20% emerging market equity, because that's where all the growth is, and 40% venture capital. Think about that, 40% venture capital. And it's because he believes in innovation as an asset class. But the best performing fund is neither one of those. It's a firm called the Dietrich Foundation, and their asset allocation goes back to the investment committee should be an odd number and 3 is too many. The guy said, I'm the investment committee, so I don't have to argue with anybody. I'm going to put 15%, 1-5, in cash to fund 2 years of spending, and then 85% in private. And the bulk of that is going to be in venture and growth equity, and 25 of the 85 points are going to be in China. So Chinese private investments is 25%. People's like, oh my gosh, that's so risky. It's not risky at all. Okay, it's where the growth is. He's doing proven business models that make tons and tons of money. But most people perceive risk incorrectly in that they hear China, they hear risk. They hear venture capital, they hear risk. Well, it's only risky if you did one thing, right? If I made one venture investment in China, that's pretty risky. If I made one venture investment in the United States, pretty risky. But if I have a whole portfolio of innovation, I'm going to have great outcomes.
For sure. I want to go through a couple of thoughts that you have. I'm cheating because I know you well enough to know that the buttons that hit here. But we'll go through a couple of these and then we'll get to Bitcoin and crypto. The first is inflation steals wealth from the poor. Now, Mark could talk about this for hours.
Yeah. We'll try to keep it short. But look, I told the story about the creature from Jekyll Island and why the Fed was created basically to enrich banks and steal wealth from. The second part of that is it's created to steal wealth from the poor and the middle class. People say, "What are you talking about? It saves us." No, it doesn't. So the idea that inflation is a good thing. And we've been sold a bill of goods over years that inflation is a good thing. Well, it means, my income's rising, or I get a raise every year, or get a cost of living adjustment. Well, yeah, that's fine. But what it's really designed to do is to inflate the value of assets, real estate, stocks, etc. Now, the problem is 49% of people in this country don't own any assets. Mm-hmm. Half the people in this country couldn't raise $400 for an emergency. Mm-hmm. So they don't own the assets that are being inflated by this mythical devaluation of our currency.
So just to give everyone who's listening a quick kind of context here, there are 2 ways that this 49% are essentially affected by inflation. One is they don't have something called an inflation adjusted wage contract, yep. Which basically means if you have a job that you're working and every year you get a raise that's about 2%, 3%, yep. Whatever it is, what they're essentially doing is they're increasing your salary enough to mitigate the effect of inflation. If you happen to work, let's say, at an hourly job that doesn't have this inflation adjustment, you're getting paid the same amount. So let's just say $10 an hour every year, year after year. The problem is that actually you're getting paid less on a purchasing power basis because your $10 that hour that you worked can buy you less and less goods over time. So you think you're getting paid the same, but it's slowly devaluing away the currency that you're getting paid. That's one. 2 is what Mark's talking about, which is that 49%, they have no real assets. So they don't own anything. They actually leave their wealth in cash, mainly because they're living paycheck to paycheck. And so what inflation does is it frankly just ravages their wealth because it is being devalued away. And we're talking about the most developed country in the world where it's not like we have hyperinflation, but if you go and you look in the hyperinflation markets, like let's say Venezuela's got 10 million%. Yeah. You're talking about literally one day 10 Bolivar can go and buy a loaf of bread. The next day 100 Bolivar can't buy a loaf of bread. Right, yep. The inflation there is much more obvious because it is hyperinflation. The same thing happens in the U.S. with inflation. It's just not as obvious because the numbers are smaller.
Well, we're boiling the frog, right? It's the old back to science, right? If you put a frog in water and it's hot, he'll jump out. If you crank it up a couple degrees, it's like a bath. By the time he wants to jump out, he can't because his muscles don't work. Mm-hmm. So the same thing's happening to us. We're being boiled like frogs. And look, the Fed was created to create this inflation. And inflation said, robs wealth, because what it's doing is it's devaluing the currency. From 1776 to 1913, a dollar was worth a dollar. It had fluctuations up and down, recessions, wars, et cetera, but it was basically worth a dollar. Today, a dollar, 100 plus years later, 106 years later, is worth about 3.5 cents. So it's been
98% decrease in purchasing power from 1913.
Been devalued all this amount, and it because it's happening slowly, people don't really observe it. And so when people talk about, well, we can fix income inequality and wealth inequality, and we just need to cut interest rates again, and we just need to stimulate the economy more. I'm like, no, cutting interest rates doesn't stimulate the economy. QE doesn't stimulate the economy. What stimulates the economy is job creation. Where does job creation occur? Small businesses, not big businesses. We didn't need to cut taxes for the super big companies. That's all bogus, something called stealth QE. It's a way to financially engineer higher stock prices for the rich people.
We'll get to that in a second.
Anyway.
So the flip side of the inflation is there's basically 50-50 split in the country, right? So you have the bottom half inflation is absolutely crushing their wealth. The other 50%, they own the real assets.
Yeah.
And so if you're going to inflate the asset prices, what ends up happening is they actually are getting wealthier at the expense of the bottom 50%, because their wealth is not stored in cash, it's stored in these real assets. The real asset prices go up, and literally the inflation, they like it because it is making them richer.
Of course, yeah. And the top 1% owns the vast majority of those assets, so they love it. And they're the ones that control the government by placing the people in power who they want in power. And I make the joke today that there's no Democrats, Republicans, no left, no right. There's just in and out. When you're in power, you do or say whatever it takes to stay in, and when you're out of power, you do or say whatever it takes to get in. And that's the way we've gone. Is we have Republicans in charge, Tea Party Republicans in charge, and we just created the biggest deficit in history. Forget Republicans, Democrats, left, right. It's just in, out. And what that does is, if the 1% controls the government, absolute power corrupts absolutely. What we're going to get is a corrupt environment, and this stealing of wealth from that middle class, and that, as you said, decimation of the middle class.
And so talk maybe a little bit about the relationship between how inflation works and the interest rate cuts and the QE, basically the two tools that central banks have whenever we get towards recessive periods. They cut rates and they print more money, which is now, I love the term you use, the new abnormal.
The new abnormal, yes.
So maybe talk a little bit about how that has impacted asset prices over the last decade or so, and then also really the middle class. I mean, it's pretty obvious in terms of the wealth inequality, kind of the inflection point that's occurred over the last decade or so.
Yeah, I mean, look, the idea that, if you think about fixing of prices, any type of fixing prices, minimum wages, fixed prices in rent control, or interest rates, right? That's a bad idea. The market should set prices, and the price of money or the price of interest rates should be set by the markets. But no, we have this bunch of stale white guys that pale, stale, and male, that determine. Although we did a Janet Yellen, so, but mostly these older people who are PhDs, and they set this price, and it's very non-transparent. It's very based on human decisions and analysis, and I say all the time, why would we trust a group of people? And this is not an exaggeration. There have been 244 quarterly estimates of growth issued by the Fed. They're over. Zero, right? I could coin flip and be right half the time. They're over. So why would we think that they are going to make good decisions on interest rates policy? They're not. So then it makes the assumption that they're trying to make good decisions. They're not. So the idea that the Fed can stimulate the economy by lowering interest rates and giving better access to capital for businesses made sense when interest rates varied between some lower bound and some upper bound. And we had the craziness of the 70s, and we had the normal period of the 40s, 50s, 60s, 80s, 90s. But once you get below 2%, once you get in this zero bound of interest rates, that tool loses its effectiveness. And so raising interest rates didn't slow the economy as much, and lowering interest rates hasn't stimulated the economy as much. Well, really what that is what people forget is the economy isn't driven by interest rates. It's driven by people, and it's driven by demographics. And demographics are destiny. And you're going to ask me later, I know you're going to ask me what's my favorite, my most important book. And I don't want to give one, so I'm going to weave in a couple, but one that I think is really important is this idea of Harry Dent wrote a book called The Great Boom Ahead. And what's interesting is his first book is awesome. The rest of the books, not so much. And I like Harry, he's a good guy, but people don't like him because he's been very bearish on the market and predicting doom and gloom. But his first book is amazing. And in it, he talks about a couple things that are really, really important. One is this idea that demographics drives everything. And we can tell exactly what's going to happen in a society based on the number of 25 to 45-year-old people, the number of 45 to 65-year-old people, and the number of 65 to 85-year-old people. When you have 25 to 45-year-old people, you have low productivity and high inflation. Mm-hmm. And that makes sense. It's not because young people aren't smart or nice or good. It's just that they're not trained. They're not highly productive. And so you borrow from your customers in the form of higher inflation to train your workers. When your 45 to 65 age cohort dominates, you're going to be really highly productive and you're going to have lots of spending. The maximum spending in your life is age 46 and a half. You got the 2 kids, you got college, you got cars, you got vacations, you're spending all this money. It's like potato chips. You eat the maximum number of potato chips when you're 13. You'll never eat more potato chips in your whole life than when you were 13. And you'll never spend more money when you're 46 and a half. So things happen at certain times in your life. So it's not surprising that we had this great boom when everybody in the US, the baby boomers, were turning 45 to 65. Now, every day, 10,000 people turn 65 every single day for the next 17 years. And it's no surprise that we have less productivity and less spending, because it turns out 65 to 85-year-olds don't spend a lot and they're not very productive. Doesn't mean they're not nice people, but the demographics drives everything. And so ultimately that demographics can't be trumped by interest rate policy. And so if you look around the world, Japan was first. Japan has the oldest demographics. And so they started down in 1989, and they've had now 29 years, 30 years of bad economic growth, low interest rates, zero interest rates, and people think that that's not going to happen to us. Well, it is, because it's happening in Europe. You see almost all of European debt now is trading below zero, NERP, negative interest rates. And U.S. interest rates, despite everybody saying that the bond bull market was over and bond prices had to go down and interest rates had to go up, yields had to go up, exact opposites happen. So demographics is destiny, and the Fed is less omnipotent. In fact, this friend of mine has a great line. He says, I'm old enough, I remember a day when I didn't know the names of central bankers. I long for that day to return. And so what they've gone to do is QE. And people think QE is new. It's not new. We did it in the 30s. And Ray Dalio writes about this and talks about it, is in the 30s, we had this thing called the Great Depression. And if you think about the 1930s, we were an emerging market. The United States was an emerging market. If you've seen the movie Gangs in New York, this was not a good place to live from 1860 to 1920. It's kind of rough, and you could die walking down the street. By 1929, the Italian gang beat the Irish gang, Viva Italia. And so now we're a country run by a single gang, but no one would buy our debt. And because post-World War I, and we were an emerging market, so no one wanted to buy our debt. So we bought our own debt. So we bailed ourselves out. And then in 1937, we had zero interest rates, just like today. And we tried to raise rates to 25 basis points. And we turned the Great Recession into the Great Depression. And then it wasn't until World War II when we were able to stimulate our way out to get out of it. And so we had this 20-year period of really badness all around this idea of QE and zero interest rate bound. And so Fed policy becomes less powerful. And so now you have these central bankers who they feel powerful, right? They're voted Time Man of the Year. Ben Bernanke saved the world. Ben Bernanke did not save the world. China saved the world, right? China pumped $4 trillion into the global economy. It wasn't the U.S. cutting interest rates and doing QE. It was China. And so the key here is we're at this point now where everyone thinks the Fed is invincible. Everyone thinks central banks have it all under control. But what we've seen is it's not working, right? You had all the ECB interest rate cuts. They're in recession. Japan, interest rate cuts, negative yields. Bank of Japan now owns 75% of Japanese government bonds and 3/4 of all their ETFs. It hasn't worked. So U.S. is going down that path. And we talked about, I said I would talk about stealth QE, right? Everyone talks about the Tax Act. Why did we do the Tax Act? Tax Act had nothing to do with taxes. It had to do with the Fed, by law, is prohibited from buying stocks. They bought all the bonds they could buy. And so they need to buy stocks to try to keep the stock market up, to keep the wealth effect going, to keep stealing from the poor. And so the government said, hey, here's the deal. We'll go to the companies that have a lot of cash, Apple, et cetera. We'll give you all a big tax cut. But you have to promise to buy back your stock and pump up stock prices. So they're not allowed to do CapEx. They're not allowed to do investment for the future. They're not allowed to invest in innovation. They just got to buy back their stock. Well, why is that? Well, because people like Warren Buffett own lots of stock. So it's all a big circular thing of concentrating the wealth closer and closer in the top 1%. So I'll call it stealth QE. So now we're at this point where you got the president browbeating the guy that he hired. Right? How weird is it that the guy has hired 7 people and then within months called them incompetent? That's just weird, right? Why would you tell the world that you hired an incompetent person? But maybe the incompetence is coming from someplace else. But the key is that, Jerome Powell is doing the best he can in a flawed system, because under or approaching the zero bound, monetary policy stops working. And what you really need is fiscal policy, or more importantly, what you need is innovation, right? If it's up to me, I would create a massive venture capital fund funded by the government, funded by Social Security, and I would invest in all the great entrepreneurs, and I would own a piece of what they do. Wait, somebody does that. So it's called the government of Singapore. They take their Social Security money and they invest it around the world with the best entrepreneurs, and they are wildly overfunded in their entitlements programs because they actually invest. Instead of using a rob Peter to pay Paul system, they actually invest. And investment, particularly investment in innovation, would solve all those problems. And then we wouldn't need this, Ponzi scheme-esque way of, you keep working so I can retire. We'd solve that problem.
It's pretty crazy when you start to tie in the history of how this stuff was created, why it was created, who created it. You tie in the data of the impact that it's had, and you add in pretty educated estimates of what is likely to occur in the future, whether it's demographic or just other examples around the world. You look at a system that I don't want to call it failing, but it's definitely flawed in many ways. And the part that to me is the most shocking is one, there's incentives, whether it's from the government side or the banking side, to continue the charade, right? And kind of everyone keep doing what they're doing because, hey, I'm such and such age. I only got another, 15, 20 years. Yep. Not my problem. Not my problem. That type of thing. At the same time, what you see is one of my favorite examples to give people is every disruptor becomes the man. Right. And I think it's Naval Ravikant at one point, he made the comment that if Bill Gates was a teenager today, he'd be working on Bitcoin and crypto.
Of course.
Right. Yeah. Because at the time, working on Microsoft was the equivalent of working on Bitcoin, crypto, blockchain stuff today. And so he has gone from one of the kind of most fringe disruptor, I'm going to go and build this massive company and take on the incumbents, to now he is the man.
Of course.
And if you look across a bunch of these, that happens in entrepreneurship. It also happens in politics. And I think part of it is your example of like the in and out crowd. Mm-hmm. when people are out and they want to get in, they're very disruptive. They're very kind of, hey, this is what's going to happen. And it always cracks me up that once they get in, and it's both sides of the aisle, has nothing to do with political ideology, all of a sudden the vernacular, right, the way they articulate ideas, it all gets tempered. It kind of gets to this world, let's not rock the boat as much because now I'm in the crowd.
Because now I might get kicked out, right? It's like why boards make bad investment decisions. Once I'm on the board, now I just want to stay on the board. Mm-hmm. It's like in this group of people in this room, right? If I asked, what's the best restaurant in New York? The group will give me McDonald's. If I ask anybody individual, I'll get a really good answer. Mm-hmm. But the group will say, well, I don't want to tell him about this Indian place I know because he might not like Indian and he might like American continental food, but I don't know, it's kind of spicy. McDonald's. And it just gets dumbed down. And that's the same thing that happens in politics, is it gets dumbed down back to this level of, I just want to stay here. But the real problem is the framers set it up as a voluntary service. 2 years you went back and ran your family farm, and you couldn't be a lifelong politician. The problem is today it's not voluntary, right? It costs you $100 million to become a senator. Not very many people have $100 million lying around. Meg Whitman tried, but most people have to raise money. So, well, if you raise $100 million, you're going to owe people stuff. Mm-hmm. And it turns out when you owe people stuff, you're malincented, misincented.
I don't have a lot of opinions about politics, but the one idea, and I forget who gets credit for this, but the one that I really, really agree with is if you are elected as a representative, I don't care what part of government, what ideology, you should not be allowed to participate in the legislation creation or editing of the industry that backed you to get there.
Oh, amen. Amen.
So if the healthcare, if the drug companies put you in, you can't talk about and can't participate in any legislation that has to do with drug companies, right? If it was the tobacco industry, if it was whatever, you just, what you start to do is you change the incentives, right? And you change the way that that things are kind of occurring. We're running out of time, so we've got probably about 20 minutes or so.
Oh my gosh!
I want to talk about two things. Well, three things, because we have to talk about aliens as well. But the first is real quick, in like 3 minutes, talk about the fact that when you deposit money in a bank, it's not your money anymore.
Again, little known fact, right? People put their money in the bank and they're like, okay, that's my money. Fact is, no, it's the bank's money. Look on the bank balance sheet, it shows up as their asset, and you have an IOU from the bank. Now people say, but I can get it anytime I want. Well, yeah, you can, unless they lose it. Well, how could they lose it? Well, I'll give you an example. So I met a guy, his dad founded syndicated TV. He inherited almost $1 billion, $960 million. And I said, where's your money? He said, it's in the bank. I'm like, what do you mean it's in the bank? He said, well, I don't want to lose it. I'm like, but you could lose it really easily because it's not your money anymore. He says, no, it's insured. I said, well, it's insured up to $250K, but not $960 million.
Big delta between $960 million and $250.
Yeah, and so make a long story short, he did diversify. He put it in 4 banks. And the sad part is in the global financial crisis, one of the banks went bust. And he lost 25% of his money, minus the $250 he got back from insurance. And people just don't understand, whether it's Cyprus, literally you wake up one morning and 75% of your money is gone because they take it because it's a bail-in tax.
One of my favorite terms ever, a bank levy, right? Yeah. Which for in English format, all that means is they literally went in and said, we need to raise money really fast. Let's go to the banks and tell them, take 75, 50, 10%, whatever the number was per bank. Just take that money, call it a bank tax, and now we've got the money that we need to go do what we need.
And look, I'm not a bank hater in the sense that I actually believe fractional reserve banking is what separates the great countries from the less good countries, right? If you think about, if you can make a dollar work harder by fractional reserve lending it, it's a wonderful system, but it can be abused, and I think it has been abused, and I think the biggest problem is that we don't hold people accountable for their actions, and we bail out the powerful instead of letting them fail. I mean, Iceland's a good example. They let their banks fail, and they didn't go down the drain. Iceland's still around last time I checked. But this idea that the money in the bank is not yours is a fundamental premise that people need to understand, because everybody thinks about it as, no, I can go get it any time, but you can't. And it's like stock, right? In a brokerage account, it's not yours either. Like, what are you talking about? No, your paper stock certificate sits at DTCC, and then it's registered through a registration process with the broker, right? That you work with, but you have an IOU from the broker for that particular stock certificate, and then you get a QSIP, the electronic version, but you don't have ownership of the asset, which can change with digital ownership.
And this is all fine when things are going well. It's when things turn sour that's where the issues introduced, of course. All right, Bitcoin. We've got almost 2 hours and haven't talked about Bitcoin at all.
That's crazy. I can't. Well, I told you I don't do short well. So
that was my secret goal. You and I and Jason have gone around the country talking about this get off zero. You, unlike Jason and I, have sat on the other side of the table as a fiduciary, managed these endowments, and really kind of thought through asset allocation, et cetera. Just spend a couple minutes talking about how you think about Bitcoin, why it's interesting, and then how it fits into some of these institutional investors' portfolio from a portfolio construction standpoint.
Yeah, I mean, we talked earlier about this idea that you got to focus on innovation. We talked about this idea that disruptive technology is really important, and disruptors are important. And if I think back in my career as a fiduciary, I've sat on boards, I've managed portfolios as a fiduciary. I built a business around being a fiduciary for clients. One of the things is I've always found myself hanging out with the fringe, with the disruptors. And when I first brought the idea of hedge funds to Notre Dame, they're like, no, that's where all the bad people are. I know they're not bad people. They just make a lot of money because they're really talented. And then we wanted people to invest in distressed debt. And the board's like, oh, we can't do junk bonds. Like, well, you do realize that the bulk of your investment is in equity, which is junior to subordinated debt in terms of claim on cash flows. So maybe it's okay if you own distressed debt, even though you want to call it junk. And so this idea that you want to go where the disruptors are, where the fringe is always been pretty important. And people confuse this idea that's not fiduciarily correct. And it's only not fiduciarily correct because it's not accepted custom. If you go back to 60 years ago, the average endowment foundation didn't own stocks, right? It was all in fixed income. And then someone said, well, that's a really bad trade. And then in 1973, there was this idea that, hey, maybe we should think about international diversification. And ERISA came in, and suddenly you could do international stocks and bonds. And so what seemed outlandish or crazy then becomes customary. And one of the things I talk about in this whole theme, and we've talked about together, this get off zero, is 10 years from now, you're going to look back and everyone's screaming today about how, oh, you can't invest in this because it's not fiduciarily proper, or it's not an acceptable asset class or a customary asset class. You're going to look back and say, oh my gosh, you are a bad fiduciary if you didn't invest in this. The same way that today, if you don't have hedged assets in your portfolio, you're not a good fiduciary. If you don't have a diversified portfolio globally, you're not a good fiduciary. If you don't think about low correlation assets, you're not a good fiduciary. So all these ideas, people forget the CAPM, capital asset pricing model, is only 75-year-old technology. It's not like it's multiple hundreds of years old. So all these ideas about bringing new technology and innovation and new areas of investment into the portfolio, what start out as radical end up as accepted. And the key, again, is being early and taking advantage. And you think about, why has Yale been great all these years, or Notre Dame or Duke or UNC? It's because they're always out ahead. They're always putting the new asset classes, the new strategies into the portfolio before everybody else.
Well, I think that, look, when we first started really talking about this stuff, the one thing that you said to me that everyone knows, but no one understood, I think, is you have to talk to a fiduciary, an institution in their language, right? Mm-hmm. And so where the Bitcoin community is racing around and screaming and yelling about, it's going to be a new global reserve currency. You don't need a central bank. A dollar is screwed, right? All these things that there's a high probability are true, right?
It's possible.
Or definitely possible, right? And some people would argue are probable.
It's definitely possible and likely probable,
Yeah. And so if you kind of say, okay, that's the way that you would speak to technologists, to other Bitcoiners, to people who are looking for innovation and kind of the ideological revolution, stuff like that. Institutional investors, all that language, they run so far, so fast that it just scares the hell out of them.
Oh, no, come on. I mean, look. So here I am. It's 6 years ago, 2013. One of the guys I backed that came out of Julian's shop, Dan Moorhead, he found a firm called Pantera 13, 14 years ago. We were first money into his macro hedge fund. And 6 years ago, he calls up and says, hey, Mark, I'm shutting down the hedge fund, and I'm going to open up 2 funds in crypto, one in Bitcoin and one in infrastructure. What are you talking about? And I had heard of Bitcoin. I would say I was neither a drug dealer on Silk Road nor a cryptography student, so I hadn't really gotten exposure. But I kind of heard about it, and I went out and met with him in San Francisco, and he went from $1 billion fund to $15 million raised for this fund, and I had the first of my many bad decisions in crypto. Is I could have gone to Bitcoin fund or the infrastructure fund. I'm a picks and shovels guy. I get picks and shovels. I get infrastructure. I'm like, good, Dan, let's do that. I should have gone to the Bitcoin fund, right? The picks and shovels fund, up 10x. No one's complaining about 10x. Awesome, great. But the Bitcoin fund's up 180x. That was better. So that's late 2013. So my son's getting ready to graduate from Notre Dame. I send him out to meet with Dan. I'm like, go work at Coinbase or Zappo or something and just get in the industry and get in front of the trend. And he goes out and he meets with Dan of a couple companies, and he comes back and says, yeah, Dad, I'm not sure. I think I'm just going to go with KPMG. And it's safe. They'll get me to San Francisco where I want to be. And we got a chuckle out of it last Thanksgiving. He's like, all right, fine, Dad, you were right. But you're not as smart as you think you are. I'm like, well, what do you mean? Of course I'm smart. What do you mean? He says, no, you didn't lever up the house and buy Bitcoin. I'm like, good point. But here's the crazier thing. So first quarter 2015, Bitcoin has dropped from $1,000 down to 500. And I wrote one paragraph in these crazy long quarterly letters that I used to write, 40, 50, 60 pages, 41-page letter, one paragraph about Bitcoin as a special situation, thinking it's good investment. Okay, this is first quarter 2015, $500. I had people call up and say, we'll fire you if you don't stop talking about this crazy stuff. I'm like, wow, that's an extreme reaction. And there was just fear. There's fear of this new technology, of this crazy magic internet money, the bad guys and the Mt. Goxes and the Silk Roads, and just stop talking about it. Now, it went from $500 to $175 by September. I'm like, maybe they're right. No, they weren't right. So then it zooms back to 1,000, and now I'm back on it. I get some of our clients into it, and I get some of our people excited about it, and we do some more infrastructure, and we start thinking about maybe we should do something here, and another year goes by, and still haven't done a lot, but we've got people invested. We've got a little bit, and then Ethereum comes along. We got a little bit of interest in that. Again, not as much as Novo and others, but we got people to kind of get off zero. But what was interesting is I hadn't really had the big epiphany yet. And, you and I met briefly, 20 minutes in our conference room talking about Lyft as a private investment. I couldn't believe
they let me in the office. Morgan Creek's got this nice office in Chapel Hill. I came in a T-shirt and a baseball cap, and I was like, I think that I might have underdressed for this one.
Well, and it was worse, right? Because you were that guy from California who had just left Snap and moved back home and kind of had the myth and legend of the Facebook time. And so there was this kind of, it's just nice to meet you, but we didn't spend that much time because I didn't get it yet. And, about maybe 3 or 4 months later, we're doing a podcast. You did a podcast with O'Shaughnessy.
Oh, Patrick O'Shaughnessy.
Yeah, Patrick O'Shaughnessy. And it wasn't even that long. It was like 25-minute podcast. And, you know, O'Shaughnessy, Patrick's a Notre Dame guy, Jim's a Notre Dame guy. And so I listened to the podcast, and I was like, it's an interesting guy. We need to meet. I was like, wait, I did meet him. I was like, hey, give me his contact info. And you know, I sent you, I think I sent you a direct message on Twitter because, you know, I started following you, and it was, I said, like, and it's just weird. It's like everything coming out of your mouth is something I would have said. And we got together for breakfast, and, you know, my famous line, I'm not a morning person, and you showed up early, and you had your coffee, and we got talking, then we had breakfast again the next day, and then a couple of days later, and it became very clear very quickly that there was something here, and it was something we needed to focus on together.
Yeah, and I think part of it is when you go and you talk to these institutions, right, and you told me that early on, hey, look, this is likely going to be a interesting but not interested type relationship or conversation, and what I realized was, in a number of those early conversations, I had the same experience that pretty much I think every fund manager in the space had, where people just didn't get it. Mm-hmm. The second that you and I sat down and Jason and I really were like, hey, okay, well, what about this? What about this? What about that? You know, hey, this is why we were excited about it, whatever. You very quickly said, okay, don't use that word, right? Use this word. Hey, don't talk about like, you know, taking down the financial system. Yeah. Maybe talk about like a non-correlated asymmetric asset.
Yeah.
Right? And you really learn that, oh, wait a second, you're saying the exact same thing.
Yep.
You're now saying it in a different language that resonates and kind of checks these mental boxes for an institutional investor. And when you do that, what you give them is less to worry about, and you give them a much cleaner kind of framework to evaluate the opportunity.
Yep.
And I joke all the time when I say the idea of a non-correlated asymmetric asset to 99% of people in the world means nothing. Mm-hmm. When you show that with data to an institutional investor, they have to pay attention.
Have to.
Right?
Yep.
And they'll argue with you the qualitative nature, if it's sustainable, all these kind of nuances. But just that one thing, it is this trigger that kind of flips them over from I'm not interested to I have to be interested. Yeah. Let's see what happens.
Well, you're exactly right. And again, it's why we've been great partners as we feed off each other and the ideas. And to your point, you know, back to my first mistake with my board, right? 40 recommendations. No. These were observations. Don't threaten them. So don't go in to an institution saying, hey, this thing's going to take down the financial system because, oh, by the way, 100% of my assets are in the financial system. I don't want to hear that. So what I do want to hear is, okay, technology has progressed, and this is something that, you know, became very clear for me. It was like this aha moment, this eureka moment that, you know, I've been investing in this technology cycle: 54 mainframe, 68 microchip, 82 personal computer, 96 internet, 2010 mobile net, and now 2024 the trust net. My term, use it frequently. But people want to call it the Internet of Value or the Internet of Things or whatever it is, or the blockchain era. But it became very clear that as DOS was to operating system for PCs, iOS and Android are the operating system for handhelds, and now we're going to have this operating system for the Internet of Value, and that is going to be blockchain technology. And I did have this epiphany moment. I even wrote about it, you know, from Eureka, California, that I had this eureka moment, and I was like, oh my gosh, we have to do this together, and we have to build. And you have to do it because it's way better coming from you. Is, you know, you, very successful guy, lots of background, and it's amazing. I had all these questions I was going to ask you, and I didn't do any of it. But give me give the story of why did you and Jason decide to partner with us? You know, stodgy, staid institutional firm.
I always use the example of like a Venn diagram, right? Which was Jason and I had been investing in kind of a micro VC style into a bunch of these companies, kind of started out, are we good at this? Okay, we might be good at this. Okay, I think that actually we can go find a lot of these deals. Let's go raise more money. The institutional world's interesting. You and I started talking. I always joke with Jason and said, I tricked Mark because Mark was learning from me about crypto. He didn't realize I was learning about the institutional world.
It's a good trick.
But I think that in those conversations, what became very obvious was we had talked to a bunch of people in kind of the institutional asset management world, and they were all bankers, right? And I use bankers as like kind of a banner title that is not a negative title. It's just they come from the traditional financial world. They're trained in the traditional financial world. That's how they think. That's how they act. That's who they surround themselves with. And it's a very specific mindset. On the other side, you have all the crypto folks, right? All the Bitcoin folks who are just hardcore, decentralize the world. This is new technology, very innovative, very disruptive, et cetera. And when you bring together those two separate buckets of people in a kind of an Venn diagram, the overlap, it's actually a really, really small set of people who come from the institutional asset management world, understand kind of traditional finance, markets, asset allocation, portfolio construction, and also understand innovation, disruption, right, technology, et cetera. Obviously, you've been talking about a lot of those things today. And so in that bucket, there was even a smaller group, literally one, which was you and Morgan Creek, that I think aligned with us in terms of you're not a trader, right? Mm-hmm. You're not going to go out and hedge fund and in the sense of let's go pick stocks and trade. You're not going to just long passive index, right? There's a very specific kind of equity, bent or bias, and more venture capital, private equity type infrastructure, et cetera. And so, very early on, I remember having two specific investment thesis, which was, hey, Bitcoin's interesting as this idea of an algorithm is going to store value for people. I've said this on the podcast a million times, and now that Mark's here, I can say it, and I'll say it when Jason's here as well. I'm 31, Jason's mid-40s or mid-50s, and when you put that together, it becomes a really interesting collection of experiences and perspectives because I can sit there and say, trust me, there's a whole group of people like me who are going to trust this algorithm to secure their value, right? Their wealth. And while that's weird to, somebody who's sitting there saying, look, I've been doing this for 30 years and there's no freaking way that somebody's not going to put their money in a bank. Correct. And then they say, oh, hold on a minute. Actually, there's a lot of people like this, right? I think that's a really kind of beneficial thing. And the second thing was this: every stock, bond, currency, and commodity was going to get digitized. And I think that, kind of the historical perspective of the shifts already happened before from the analog to the electronic world, electronic, digital. It just made a lot of sense of there was things that you guys brought to the table that we had no clue about. Not even that we couldn't do, just we had no clue about. And I think vice versa, there was things that we brought to the table that you guys were like, look, we kind of heard about it, but, help accelerate this. And bring that together.
The point you make about youth and aged, look, you get wise as you get older, right? Just because you made mistakes and you survive. It's like the firefighter who says, he has a sixth sense. No, he just fell through a lot of floors and didn't die. So now he knows to touch the door before he goes in, and he's wise. And so, but with that wisdom becomes this intransience about, oh, no one would not have a bank account or a brokerage account. Well, geez, I know people who don't have either of those and have 80+% of their assets in crypto. And actually, when I think about it, that's actually not illogical given where we're headed. And so what was great for me was again, that epiphany of saying, 1 + 1 + 1 is 5 or 10 or more, as the three of us together created this asymmetric upside potential in terms of building a new venture that took all of the benefit and all the wisdom and all the experience and all the relationships and all the knowledge that we had for 15 years at Morgan Creek to then kind of lasso this shooting star that we want to ride along with, that is going to be this new asset class and this new fiduciary standard, or the Bitcoin standard that's coming. And I said the interesting thing for me was also if you go back in history, all of the great intellectual and technological innovations come from young people, right? Mark Andreessen was not a 55-year-old guy when he invented the browser. He's doing great stuff now too as an older guy, but the youth is where this comes from. And I say Bill Gates, he got mistaken as the coffee boy by IBM, right? IBM passed on Microsoft the first time because they thought he was the coffee boy. He's better than coffee boy. But youth is really where it's at. And the most, I've had more fun in the last 2 years than I probably had in the last 20. One, because I get to hang out with young people who are enthusiastic and really doing interesting things. And while I can't keep up the pace, right? I used to think I worked hard until I started, working out with you. And, I love the fact that I am reverse aging. I'm becoming less rigid in things that I thought were absolutely true. And I'm going back to that wonder I had. Look, when I was 34-year-old as a CIO of a university, and people were like, what the hell, how'd you get that job? And it goes back, again, I pick on my board chair from UNC, but he was actually an amazing guy and he was very successful. And he had a great line when I asked him. I said, why'd you pick me? He says, I'd never hire anybody over 35. I was like, why not? And he says, because the way it works in this world is your 20s are for getting educated, your 30s are for building your reputation, your 40s are for capitalizing on your reputation, your 50s and 60s are for enjoying your reputation. And so by 35, you don't want to work hard. And I need people to work hard. I'm like, wow, that's really interesting. And there's this sense of wonder, this sense of potential achievement and motivation. And I feel like I've got reinvigorated and have it again. So I clearly am not 35 again, but I feel like it. Plus I have an 8-year-old to prove it. So I think that combination of youthful enthusiasm and a sense of understanding of that generational shift, along with a business builder like Jason, who you'll talk about on the next pod, and my experience in building an asset management business comes together to do something really special.
I agree. I'm biased, but I agree.
You're biased, yeah. That's good.
Aliens, real or not?
The concept of aliens, definitely real.
Okay.
The idea that we're alone in this series of universes, impossible. The idea that aliens have visited this planet, I'm not there. I think
I'll agree with that.
My thing is that, like the last week, I've been laying in my backyard staring up at the sky trying to find the Perseids, and it just ticks me off that we had a full moon right at the meteor shower peak, so I couldn't see as many as I wanted to. But when you're sitting up looking at the stars, it's kind of, again, it fills you with a sense of wonder. And when you look at one of the sky apps on your phone, and you see just the gazillions of stars and universes, and you think, no way we could be alone. So mathematically, combination of things you need for life. But I think it would take a different form and a different format. But the idea that little green men have landed on this in Area 51 or stored there, I'm not there. Don't buy it.
I think that is probably the most intellectually sound way that people look at it is life probably exists somewhere, just from a mathematical basis. It doesn't probably look and act the way that we see it in movies. Yeah. And if it's anywhere, it's like in an Area 51 type thing, but unlikely that.
My thing is, it's space travel is just too hard. Yeah. Right. The idea. Someone had a great line yesterday that I saw on Twitter. It said, if there were a planet that was 51 million light years away, and I don't know why they picked that number, and they could actually see here, they'd see dinosaurs. And I'm like, okay, that puts it in perspective that, Star Trek, like I had, one of my Twitter moments was, William Shatner added me. And I'm like, wow, that's kind of cool. Because I grew up, watching the guy. And the idea of Star Trek, going from planet to planet, no. It's just not happening. Colonizing Mars, not happening. Just not happening.
We won't go there. That's for a whole other one.
You've actually been pretty good not letting me go down the Tesla rabbit hole.
I'll let you ask me the one question to end this, but just for the record, Mark is a Tesla bear and I am a Tesla bull, and we have very spirited debates.
It's good.
All right.
If two people always have the same opinion, one is unnecessary.
Very true. What one question do you have for me? I told you you're only going to get one question this whole time.
I have so many, but the one is, one of the things I really admire about you is your commitment to everything you do. I mean, you are all in 100% of the time, and one of the things that had to be just devastating in some ways and challenging in others was basically being disrupted in the middle of college to go off to the Army. But what was the one thing you took away from that experience?
So the all-in thing, there's a saying as kids, my brothers and I, and then a number of our friends used to joke about, but there's, in every great joke, there's a hint of truth type thing, is anything worth doing is worth overdoing. And now we used to use it as kids of like, oh, well, if it's worth eating ice cream, just eat the whole bucket, right? And you can imagine all the ways you could apply that as a kid to basically piss off your parents. But I do think that there's a lot of truth in that and things in life. And if you use that as a filter, you start to change some of the things that are worth doing, right? And so when I went to Iraq, I'd signed up basically for like this reserve contract, and then I would know some time after college. I'm a junior. I had known that it was a possibility, but very small. They call, and like I'd kind of not paid attention, so it was like, oh, if I don't pay attention to the possibility, then can't come to fruition.
Happen, right? It's like the ostrich turning his back on the lion.
Yeah,
can't get eaten.
And so all of a sudden they said, hey, in 1 week you have to report. And I was like, oh, that's like real.
That's true.
And so I went, and for me, I was 20, and I always joke and say I went to basic training when I was 17. They were yelling and screaming at me. Anyone that was like over the age of like, I don't know, 25, they had enough self-respect to realize like, why are you treating me like this? At 17, I was like, oh, you're nicer to me than like the football coach was. So you're kind of just in that time of your life, you're used to everyone yelling. Your parents yell at you, your coaches yell at you, your teachers yell at you. It's all whatever. When I went at 20, I was too dumb to realize how dangerous it was, because you kind of think like you're Superman, right? It's just like, oh, like this is going to be fun. Which is really weird now. You look back, literally it's 11 years later, and I'm like, whoa, like that was pretty crazy. But the other piece of it was I was there with a bunch of older guys. So I think that like the average age was like 28 or something, which was very uncommon. So this isn't kind of the active Army. This was a reserve unit. So the guys are a little bit older. They've been in for longer. And it was weird at first to go from like the 20-year-old playing football in college and like what's the party on Friday night, or Saturday night after the game, to the dude who's sleeping next to me literally like 6 inches away on a cot is talking about his mortgage or his kids at home, right? Or whatever. And what you realize is like, you just get this crash course. And when I came back is when I noticed the big difference, because all of a sudden the things I'd cared about before I went really didn't matter, right? It's like, where's the party? I got other things to do.
Got other things to do.
Right? But what it taught me was the idea that like the people you surround yourself with, you very quickly adapt to, and kind of your mindset changes to that. And it wasn't so much like, oh, they were great investors or entrepreneurs or anything that like the business world cares about. It was the fact that they had these guys were from like the backwoods of Pennsylvania. They had good values, they had real lives. And there was no kind of like, Travis came on the podcast one time, he used the word fuckery, right? It was just like, this is life, right? And so when you're surrounded with that for a year, you kind of grow up pretty quickly, and you realize like, hey, there's a pretty clear line here of like the things that matter, the things that don't matter. And so when I came back, all of it, like everything changed, right? So it was very much for me an accelerated, I grew up. Yes, it was a dangerous situation, but when you get back and you kind of survive that, now all of a sudden you're like, hey man, it's like a new lease on life type thing. And so you hear people who go to jail, people who are in these near life situation or near death situations. They all kind of have the same takeaway of just live life to the fullest, or kind of anything worth doing.
But I think the real thing for me in listening to you give that answer is the who you surround yourself with. And I talk about this all the time, is look at the 5 people you spend the most time with. That is who you'll become. Choose wisely. Choose wisely. And I think that's why choosing your partners is important, why choosing your associates is important, your spouse, your significant other. All those things are critically important. And It's a great takeaway.
I couldn't agree with it more, and I think that it's people know that it's really, really hard to execute until they get in the situation, and then when you get in the situation, the thing I'll leave everyone with is when Jason, myself, and Mark decided to work together. I remember we walked out of the Morgan Creek offices, and I said, "What'd you think?" And he literally said to me, he goes, "We just jumped from high school to the pros." And I always remind myself of, there's an element of you're forced to raise your level of effort, your level of your game, etc. when you surround yourself with that. And so it's the same reason, why do all these NBA guys that are stars, their kids end up being really good at basketball? Well, because they're playing with NBA players every day.
Yeah.
Kind of accelerates the things that you do. So,
Amen.
It's been
and to that point, and I know we're running out of time, but you didn't ask, but I do want to talk about it real quickly, is most important book. And it's such a tough question, and I always joke that my wife reads more books in a month than I've read my whole life. So I don't read many books. I read so much for work and stuff that I just don't read books. But the one book that I have read that I do think is a life changer, and it has a little bit to do with why we're together and doing this, is The Alchemist. And what it talks about is this idea of a personal legend, and knowing what your destiny is and pursuing it. And a friend gave it to me at the right time. Things happen for a reason, of course. And I read it at the right time, and it was just all the things that went into it. And there's a line in there that I love, which is, if you really wish for something, if you really want something to happen, the universe will conspire to make it so. And I think this is a great example of that. I knew I was interested in blockchain and Bitcoin and crypto, and I knew there was something there, but the universe had to conspire to bring you and I together, and then to bring Jason in to give us the opportunity to create Morgan Creek Digital and to change our business model, right? From fund to funds to direct investment, from managers and public markets to really focusing on venture capital and innovation, and to get me to kind of revert back to my entrepreneurial, let's build this, and also in that conspiring, it's getting you guys to conspire against me in a positive way of saying, hey, let's sharpen the edge, and let's not focus on stuff that isn't as important or can't make as much a difference, and let's focus on what's really important. And that's been good. And so whereas a book, people think can't make a big difference sometimes, but in many ways that single book or that single idea can make a huge difference. And then one throw into best investment book is a book called The Dow Jones Averages, and Dow is spelled T-A-O. And it's a mixing of ancient Chinese philosophy and investing. And what it talks about is most investors are too left-brained, right-handed, analytical, backward-looking, and the best investors are whole-brained, and they have to have that creative side and that ability to see things differently. And there's a whole part about why women are better investors. It's called women intuition for a reason. And I was listening to your pod the other day with Scaramucci, and I was listening to the one with Novogratz, and one of the things that they talk about a lot is this idea of intuition and trusting that intuition. And my intuition on you, on Jason, on this opportunity, on morphing Morgan Creek, and in Taoist philosophy, water, creek, Morgan Creek, it comes to the obstacle, it goes around it, it shapes the obstacle. And I think that's where we are in this journey, in this alchemist type journey.
I think that we're going to be more right than wrong, so we'll see how this plays out.
Absolutely.
All right. This is officially the longest podcast we've ever recorded, which I appreciate you taking so much time to do this. Hopefully everyone listening to this really enjoys it, and we'll have to do it again in the future when we've got more stuff to talk about.
Yeah, exactly. So much fun. Thanks for having me.
Hey everyone, Pomp here. If you like this episode of Off the Chain and want to help us take crypto to the top of the Apple, Spotify, and other podcast charts, please do us a favor and rate, review, and subscribe. To review, simply go to the Off the Chain homepage, scroll down until you see the 5 blank stars. Taking 15 seconds to fill those stars in and leave a quick review goes a long way in helping us take the entire crypto ecosystem to the top of the charts. I appreciate you listening and see you next time on Off the Chain.